that big story is really going to continue to be AI and tech.
I think you stay in a Mag 7.
It's still so early in this game that it's very hard to declare where the ultimate winners are going to be.
The same sectors that have been strong for a couple years before are going to continue to be strong.
It doesn't take much disruption to have quite a few domino effects that are going to impact the market in a more holistic way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Happy New Year. Welcome to Bloomberg Surveillance, starting 2026 on an upbeat foot with futures rising in early trading, building on 3 straight years of double-digit returns. But some big questions looming about complacency, with almost every single Wall Street analyst feeling optimistic about the year ahead. And metals continuing their rip-roaring rally, with aluminum surmounting $3,000 a ton for the first time since 2022. Matt Miller, I am so pleased to say came back to join us for the next 3 hours. Matt, wonderful to see you. John and Annmarie will be back on Monday. But really, to me, the optimism is just really notable heading into this year.
Yeah, well, I mean, it is a big move in futures if you discount the cash trade on New Year's Eve. I mean, we were down 0.75% on Wednesday after a bad day on Tuesday and a bad day on Monday. So we haven't gained back anything that we lost this week. I would say it's still pretty bad.
So if you sit in this chair, do you have to be really bearish and negative on the world?
Exactly.
I mean, come on. We had an incredible year, right? We had 3 straight years of double-digit gains. We haven't seen a fourth coming back with that type of return going back to the late 1990s. Everyone is optimistic except for Matt Miller, who's sitting in that chair over there, and saying, look, we can build on this because AI, while overvalued in certain pockets, is truly a transformative technology.
Yeah, I mean, look at all of the gainers in the pre-market. They're all of the same gainers from last year. Micron Technology is one of the biggest winners, along with Vertiv, right? Dealing with nuclear power. You've got Palantir, one of the biggest gainers today. Tesla, even though Tesla is going to have delivered only 1.8 million cars in 2025, the stock is up today. That's not a good signal for me.
Matt will continue with trying to pour some cold water on what otherwise would be an optimistic morning. He is right about Tesla reporting sales figures coming for the fourth quarter later this day. And a real question about its role as part of the Magnificent Seven. Right now, despite what Matt is saying, you are seeing futures green across the board, led by, guess what, big tech, up 1.1%. Screaming back after the outperformance last year. You're seeing S&P futures up 0.7%. And Russell 2000, a real question here about whether you get that broadening up 0.9%. If you take a look at the bond space, 2s, 10s, and 30s, continuing the trend that we saw in 2025 as well, with yield curve steepening. Yes, you're getting a bid into bonds, but look at that 30-year yield, 4.84%. You're seeing the steepest yield curve going back to a couple days before the beginning of the year. And the metals trade. We have to keep coming back to this. What is gold? What is silver? What is aluminum? What is copper telling you? It is telling you that the physical world is getting more expensive. The fact that silver is back on its tear with a 4% gain after the volatility that we saw last week shows how much people are still pouring into a trade that just had its best year since 1979. Coming up this hour, Jeff Yu of BNY as Wall Street looks to start the new year strong. Andrew Bishop of Signum Global as President Trump threatens to intervene with protests in Iran, and Eric Fish of HSBC with retail's winners and losers heading into this new year that we currently are in. We begin this hour with stocks pushing higher on the first trading day of the year. Jeff Yu of BNY in writing, investors are navigating a market that feels both familiar and fundamentally different. Growth is uneven, but still has room to run. Jeff joins us now for more. Jeff, good morning. Happy New Year. Wonderful to see you. I want to start with something that you said in your latest report, which is sometimes it's better to ask good questions than to have answers right now. What are the key questions you're looking at heading into this year?
I think from clients' point of view, the questions are, sustainability. As you've said, we've had 3 good years of double-digit returns. Can we extend that to a fourth? And overall, it's if I am concerned about valuations and the like, and there is going to be a bit more of a volatile path, what are some of the defensive positions? How do I diversify? I think those are one of the questions as a responsible investor. You stay the course. If it ain't broke, don't fix it. But you need to know where some of the pitfalls are. Look look at them in advance and identify the insurance plays. So I think that comprehensive approach is going to be the key question as we asset allocate heading into 2026.
Jeff, one of the key questions about diversification is what are you diversifying against? Is it inflation risk or is it the risk of recession? Because the potential diversifiers are completely different depending on that answer.
I totally agree with you, and I think it's different diversifiers for different markets and also in different regions. If I look at the run of European data that we've had this morning, I'm afraid it's looking a bit more stagflationary. So if we're going to worry about inflation and worry about a stagflation environment, I would probably worry more about Europe than the US for this year. If I look at APAC, for example, Asian bourses are doing quite well. So there's a bit of a tech run there too. So can that actually take place, but not at the expense of my tech positioning in the US and elsewhere, and how do I defend against further trade volatility up ahead? So I think all of these aspects are important, but look at it on an individual market basis, rather than you think that there's one insurance play that can defend against everything. I don't think that works anymore.
What about the broadening out, Jeff, that we've heard so much about? There have been a lot of head fakes. We finished the year with all of the high bandwidth DRAM makers winning the S&P 500, Western Digital, SanDisk, Seagate, all the biggest winners in terms of the individual stocks. And then Robinhood, Newmont, Lam Research, Palantir. Those are exactly the same stocks that are up today in the pre-market. Are we going to see a broadening out, or is it just going to be the same, top 20 stocks pushing this rally into 26?
I think that goes to a broader question about the broader economy. So, can that K-shaped growth that we're seeing, not just in the US, but I think other economies can sympathize as well, can that actually narrow a bit so that K sort of converges, the two arms of the K, into more balanced growth? And here's where we get a multiplier effect into the broader economy. So, can Main Street benefit as well? If I look at our underlying positioning data, yes, tech has done well, but consumer-related segments have really softened, and that points to a margin story. That points to a demand story as well. So can we have that the so-called trickle-down effect into Main Street? If that can happen, then we can see a broadening out from the tech stocks, which are overheld, of course, heading into 2026, but into some of the consumer-oriented stocks as well in the US and also in EM. I think that is a consensus view for the year. Asset allocation into EM tech, but for China, for Japan, and for the rest, can we see EM consumer stocks do well? Are we going to see a fiscal push benefit consumers? So globally, it really is about Main Street. If Main Street can pick up, then we'll see that broadening out. But I think on the fiscal side, markets are waiting to be convinced.
Here in the U.S., of course, everybody in markets wants to see, or everybody, I guess, long stocks wants to see Fed cuts. Is that going to continue? And will that help Main Street, Jeff? Is that going to be able to bring down mortgage rates and auto loan rates, which so far haven't responded very well to 175 basis points of cuts?
So I think the question is, as the Fed cuts rates, and I think that is going to be a consensus view, of course, your cash flow improves on the liability side. What Main Street wants to see, not just in the US, but around the world, can real incomes grow? And if it can grow, can expectations pick up? You look at the UK, for example, as Governor Bailey has highlighted, wage growth is very strong, but you're seeing savings rates go up as well. It looks like the UK is going to run a double-digit savings rate on a sustained basis, which is unheard of, right? So what is it that's holding back the consumer in the US, in the UK and elsewhere, and also in APAC? They're sitting on high savings, but they're not spending. They're not pushing it into the broader economy. So I think that requires more stability in terms of their expectations. Yes, wage growth is firm right now. Can that be maintained? And the US economy, this no fire, no hire economy, let's move into a more hiring economy. I think that's what's needed to get Main Street going and to lift the consumer segment.
Right now, the consensus is that the dollar will weaken, even if you do have stronger growth than, say, in Europe. And it's because of the rate cuts that are expected. What do you think is going to be the main driver for the currency? The actual growth rate or the expected rate cuts by the Federal Reserve, with the rest of the central banks around the world largely sitting on their hands?
So I think it is going to be policy differentials at the end of the day. So as long as we go through this so-called hawkish cut approach with the Fed, I think dollar downside is going to be a bit more limited. Yes, there will be hedging, and the costs of hedging will factor into that, as rate differentials shift around. But if I look at APAC, right, APAC FX is where we see the most capacity for strength against the dollar. It's not going to be in Europe. I've been wrong on euro dollar last year, so this year I still think euro is looking a bit stagflationary, so I think euro strength is going to be capped. But dollar weakness against the likes of the renminbi, against the likes of the yen, that is the consensus view. But I'd be a bit more cautious there too. Yes, APAC currencies will rally in real terms, but in nominal terms, I'd be a bit more careful. If China, for example, can shift PPI from negative 2.2%, 2.5%, that's the values right now, towards positive 2, positive 3, that kind of real effective exchange rate appreciation is something that they would probably be more happy with. So position for your dollar very, very carefully. If there's going to be dollar weakness, I'd probably see it more against APAC rather than European currencies.
Speaking of China and sort of U.S. versus China dynamics, Xi Jinping over in China had this New Year's message that he gave in an address. China has become one of the world's fastest rising economies in terms of innovative capacity, giving a nod to the war in terms of AI prowess between U.S. and China. Do you have a sense of who is going to come out ahead at the end of 2026?
So I think the direction for innovation and AI, if we look at it, the application, for example, is a bit divergent. So I think both can lead in terms of one is consumer facing in the US side. On the industrial side, that's what China's focusing on. But what investors, what the positioning is looking at is, can we see AI prowess in China and also beyond translate into higher margins, higher earnings growth, and that can lift the consumer. That seems to be the missing link in asset allocation right now. But having said that, a lot of savings are being pushed into AI stocks in APAC. We've seen the IPOs, the reaction over the last 24 hours of trading also. Hence, that theme is going to play out in the different fields, of course. But again, can that translate into growth into Main Street earnings and wages and lift Chinese consumer spending as well? That will require not just on the corporate side, but on the fiscal side. I think that's going to be one of the big pushes for EM growth this year, and will have positive benefits for the rest of the world as well. If you look at Europe, for example, it wants to see stronger Chinese demand. That trade deficit certainly needs narrowing.
Yeah, that's definitely going to be a big question about the fiscal impulse, not only in the United States and Europe, but also in China. Jeff Yu, wonderful to get your thoughts, as always. Jeff Yu of BNY there from London, and he was talking about China versus the U.S. It seems like China has already taken the lead, Matt, when it comes to electric vehicles, particularly BYD versus Tesla.
Oh, yeah, BYD absolutely crushing it. But it's important to note that they make far less expensive vehicles, right? And they're in a market that's really accepting of EVs. What I think is awesome to watch is BYD getting an inroad into Europe, right? Cars starting to sell there. And here in the U.S., you can't yet buy them, but I do know some auto executives that have imported them for research purposes and are really bullish on the build quality. So really interesting story. We're
going to be getting more on that in just a minute. Let's get more on that and other stories. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. We begin with tragedy in Switzerland. Officials say that around 40 people have died in a fire at a ski resort bar where partygoers were celebrating the new year. They estimate that more than 100 others have been injured after flames ripped through the bar at the popular alpine resort Clermont-Tonnerre. Eyewitnesses said that a sparkler in a bottle ignited the ceiling. Elsewhere, the US continuing to ramp up the pressure on Venezuela. The Trump administration sanctioned Chinese companies and oil tankers linked to Venezuela. This comes as the US launches more strikes on purported drug trafficking boats. Venezuelan President Nicolas Maduro says that he's open to negotiating with the US to combat drug trafficking, but said the US is trying to force him from power and gain access to Venezuela's oil reserves. And as you were discussing, BYD likely surpassed Tesla to become the world's largest electric vehicle maker in 2025. The Chinese company met its full-year sales target, delivering nearly 8% more vehicles than the year before. However, BYD is now facing growing pressure as China scales back some incentives supporting EV purchases, as well as growing domestic competition. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, locked and loaded, President Trump threatening to intervene if Iran kills peaceful protesters. Andrew Bishop of Signum Global joins us next as the international focus continues at the White House. This is Bloomberg Surveillance. Good morning. with some gains after a pretty soggy end of 2025, nonetheless building on 3 straight years of double-digit returns, which you are seeing in the NASDAQ is more than a 1% boost in futures. S&P futures up 0.6%, so about half of that gain that you're seeing in the tech-heavy sectors. Euro-dollar still around 117. 10-year yields have been higher. It is notable to see. Today we're getting a bit of a bid into bonds, but we did end the year and continue to start the new one with a steepening in the yield curve. Aluminum up 0.5%. We are seeing aluminum past $3,000 a ton for the first time going back more than 3 years. It seems like, Matt, the metals trade still very, very hot.
Yeah, it's interesting. We heard last week from Elon Musk, or maybe it was earlier this week, pre-New Year's Eve, about the importance of silver, obviously, for production of cars. It's a key asset. And then aluminum is even more important. I mean, aluminum and steel together make up about 65% of the average car cost. And for a company like Ford, which had a fire at its Novelis plant, it's even more important because the F-150, the best-selling nameplate in automotive for the U.S., is an aluminum truck. So it's a very big problem for car makers.
Yeah, especially because there's a real question about the supplies, where the supplies are going to come from and how available they will be. Internationally, that is increasingly a focus as the White House shifts its focus to geopolitics. And it raises questions about what the capacity is to act in international waters. Under surveillance this morning, locked and loaded, President Trump saying the U.S. is ready to rescue Iranian protesters if they are attacked by authorities. Protests escalating over the country's deepening economic crisis. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, locked and loaded, what does that mean?
Yeah. Hey, Lisa. Good morning. Well, President Trump did not provide specifics on what actions he was considering taking, but it does mark an escalation in what has been a series of threats in recent days by the U.S. Earlier this week, President Trump vowed next to Israeli Prime Minister Benjamin Netanyahu to strike Iran again if it rebuilds its nuclear program. Of course, international sanctions against Iran's nuclear ambitions have led to the widespread economic problems that are fueling these protests, from inflation to a currency that's rapidly depreciated, losing 60% of its value since the June war with Israel. Now, our analysts at Bloomberg Intelligence say that there is a very strong likelihood that we could see Iran take a more heavy-handed approach to these protests if they do continue in the coming days. And while President Trump has long vowed to curb Iran's nuclear ambitions, these remarks overnight do signal more of a willingness to intervene in a foreign crisis, something that he broadly campaigned against, but of course comes against this broader geopolitical backdrop that the White House has been escalating tensions with Venezuela, taking in recent days actions to curb the so-called shadow fleet that Venezuela and Iran actually share to transport their oil. Now, Lisa, President Trump earlier this week did confirm that he would be willing to engage directly in bilateral talks with Iran since those discussions have stalled. In fact, you'll recall it was Annmarie who back in March had reported that this White House gave Iran 2 months to reach a deal on its nuclear program, which obviously never materialized.
Tyler Kendall, thank you so much. And yes, Annmarie will be back in the seat on Monday to continue with that reporting. Andrew Bishop of Signal Global joins us now for more. Andrew, what do you make of this locked and loaded comment? Do you think that there actually are plans in place to intervene by the U.S. in Iran?
So I don't think the plan is to intervene. I think this should be read mainly as attempting to give the protesters a chance, right? So to essentially tell the regime there should be a red line not to cross, and that is, quote unquote, violently kill. I think it is interesting and a bit gruesome, but interesting the way that the president chose his words. That essentially supposes that if they are killed, but perhaps not shot out during protests, but instead arrested and, disappeared, that would be a little less sort of crossing the president's red lines. Also potentially shot at with rubber bullets. We know that in previous protests, the regime used that to blind protesters. These are gruesome details, but I think that they actually should be read in the context of the president's choice of words.
So what would we do with people if we save them there? Does that mean we'd bring them here as refugees?
No. I think what would happen if the president were to intervene in the conflict is that the U.S. would essentially target the security apparatus. So we would essentially launch, to put it very simply, Tomahawk missiles on IRGC domestic facilities, especially besieged sort of the more hardcore security forces meant to keep control of the situation. We would essentially attack those and hope that the protesters can then have a chance at overwhelming the regime's security apparatus.
I thought it was interesting that, we've been chasing this oil tanker, Bella 1, which came out of Iran, went to Venezuela, and is now headed, I guess, to Russia. The Russians have claimed this tanker, and it looks like maybe we'll give them a little leeway because it's Russia. At the same time, we're sanctioning Chinese and Hong Kong based tankers. Are we giving Russia a little bit more leeway because we want to get a truce or an end to this conflict in Ukraine?
Yes, but I would say the bigger difference between Russia and China is the fact that the U.S. Really doesn't have the ability to put any pressure on China at all. So, we sort of are in the kabuki dance phase with China, where we pretend to impose sanctions, but they don't actually bite. So I think that's the biggest difference.
So what will we do? I mean, President Trump started this trade war with China in his first term. President Biden actually carried it on in a sense, but now it looks like the Chinese have realized that their access and refining capabilities with rare earth minerals gives them a massive advantage. Is there anything we can do?
Not in the short term. I think in the short term, the U.S. And this administration have come to realize that there really is nothing that the U.S. can do to minimize China's overwhelming leverage over the U.S. And that's why we're seeing the president take such a soft, dovish approach to China. Yes, he's a deal maker, but some of the deals that he struck over the past few months with China are borderline humiliating, I think, from an apolitical standpoint, right? This famous sort of high-end chips in exchange for soybeans. It's pretty much from a bipartisan perspective. I think it's fair to say that's not a great deal for the U.S. And that's just a recognition of the U.S.'s weaker hand in the short term.
How much is this the reason why China is doing these drills around Taiwan right now?
So it is and it isn't. China would probably be conducting these drills. It's conducted drills like these every year, sometimes twice a year for the past several years. So in that sense, it's not particularly surprising. I don't think it's necessarily a result of the president's sort of soft approach to China. What's interesting or what's maybe more political is China's takeaways from the president's reaction to the drills, right? I think the State Department's press release yesterday that sort of condemned the drills and took a harsher tone was an attempt to not send the wrong message to China. But the president's decision to essentially say, President Xi Jinping hasn't talked to me about this, it's not a big deal. That is the kind of thing that Xi writes down, and potentially, let's be very clear about it, potentially factors into his decision to attack Taiwan for good at some point.
So there's sort of a panoply of potential risks geopolitically that people are looking at for next year. On one hand, you've got the China-Taiwan issue. On the other hand, you've got Russia-Ukraine. You, of course, also have Iran, as we were just talking about. And then you have Venezuela that has also been increasingly ground zero for a proxy between the U.S. and China, with China getting increasingly influential in South America. Which of those do you think is going to be the most significant heading into this year?
So on the question of likelihood, it's Venezuela, because there is a real chance for the U.S. to essentially ensure that Maduro is no longer in power, whether that's, kinetic action, CIA covert ops, et cetera. One can debate or even striking a deal with him. But let's put it like this. I think the odds of Maduro being out of power at the end of the year are well above 50%. And that's not something that can be said about the Iran situation or about an end to the war in Ukraine and so on and so forth, just because those situations are far more complicated, right? So in Iran, for example, these protests have legs, but to really go from this to actually toppling the regime, it requires a lot of steps. The security forces have to defect. They then have to take over the hardliners and win and so on and so forth. That's much harder than just essentially taking out Maduro. So from a likelihood perspective, I would say Maduro. From an impact perspective, it would definitely be Iran. I mean, Iran, turning into a different regime would have massive regional implications.
Andrew Bishop of Signum, thank you so much for being with us, and look forward to speaking with you throughout the year. Coming up, Dan Ives of Wedbush sharing his top AI picks for 2026, the changing nature of the technology trade. Plus, Lizzie Birding returns with her morning movers. Tesla rising ahead of its fourth quarter delivery report, even though it is expected to be a decline. This is Bloomberg Surveillance. Good morning. Matt might be a little bit bearish right now, but the rest of the world seems to be starting the year on a good foot. I don't know how you're looking at a 1.1% gain on NASDAQ futures and seeing doom and gloom, Matt Miller.
I'm not bearish. I'm just skeptical, right? Because the NASDAQ was down 0.9% on Wednesday. So the fact that we're up 1.1% in futures today doesn't mean a heck of a lot to me.
That's a very valid point, especially because typically the first day does not indicate the direction of the year. Nonetheless, we are building on some of the enthusiasm that we saw for 3 straight years of double-digit gains led by the tech space. You are seeing NASDAQ futures up 1%, S&P futures up 0.6%, Russell 2000 doing a bit better at 0.75%, and possibly because of the bid into bonds, 2s, 10s, and 30s. You are seeing some sort of reprisal after the best year for the debt going back to 2020. A question here, though, about the shape of the yield curve. That steepening continuing this morning with the 30-year yield at 4.84% versus that 2-year that's just been pegged around 3.46, 3.47. 3 hours away from the cash open, here are your morning movers with Lizzie Burton. Lizzie.
Hi, Lisa. Well, look, Matt, it's not doom and gloom on my screen. We're going to zoom in on the pre-market movers for the Mag 7, and we're all in the green, you see. This is the optimism continuing from last year when it comes to the AI theme. And of course, we saw 25% gains for the Mag 7 in 2025. So buyers, we're still in buying mode when it comes to this for day one of trading right now. But flip over and I want to turn to aluminium for the Brits out there. We're up past the $3,000 a ton mark for the first time in 3 years. And these names are benefiting as well. Alcoa here up 1.8% in the pre-market. You've got supply factors going into this in Europe and China, but also demand factors, bets on construction and the renewables sector as well. We're going back to the Mag 7 finally, and I want to zoom in on Tesla this time because, as you say, we've got the Q4 production and deliveries report coming out later today. They took the unusual step, though, for context earlier this week of giving us a flavour of the sales numbers outlook, and pretty disappointing compared to what some investors were expecting. So we're up 2.15% in the pre-market, but do factor in that disappointment earlier in the week. Lisa, back to you.
Thank you so much, Lizzie. On our radar this morning, the U.S. ramping up pressure on Venezuela with new sanctions on Chinese tankers accused of evading restrictions and fresh strikes against alleged drug traffickers. Venezuelan President Nicolas Maduro saying he's open to negotiating, but claims the moves are a pretext to seize the nation's oil. Meanwhile, the U.S. is cutting controversial tariffs on some Italian pasta brands. The Commerce Department slashing retaliatory rates down from nearly 92% down 92% down to as low as 2%. Italy's foreign ministry calling the move a win for cooperation, though final rates won't be set until March. And this continues, Matt, with this theme of either putting off or cutting the actual rates of tariffs.
Yeah, I thought really interesting because I'm always looking at Ethan Allen, that business just right up the street here on 3rd Avenue, that it was interesting on Wednesday when President Trump delayed tariffs on upholstered furniture and kitchen cabinetry as well as vanities. Like, they get pretty specific. But this is something that had been really interesting to me as a consumer of these things, and because I had talked to the CEO quite often at Ethan Allen. So it does seem like he's backing off to some extent of things that would hurt affordability for the average American.
Until early 2027, after the midterm election, sort of a key point there in terms of timing. Meanwhile, BYD, as we were talking about earlier, meeting its full-year sales target, delivering a record amount of vehicles in 2025. The surge officially puts the Chinese giant on track to dethrone Tesla as the world's top EV maker. Tesla set to release their sales results later this morning, and they are expected to be lower. But Matt, is it even really still part of the Magnificent Seven as a car company, or is it as an AI company, as a robotics company, as an autonomous driving company?
I mean, you're 100% right. This is not valued as a car maker. At $1.5 trillion, Tesla has a higher market cap than every single other car maker in the world, even if you throw in like Koenigsegg and Pagani, right? So it doesn't matter that they sell 1.8 million or 2 million, if they sell 3 million or 1, it's still not part of the calculus that the stock buyers are doing to value this company. And I also don't think it's an apples to apples comparison with BYD, because they sell luxury vehicles at Tesla for the most part, right? And BYD is selling some vehicles for as little as $10,000 or $15,000 a piece. It's a different product.
A clinic for why the shares of Tesla are rising in pre-market trading, despite some of those negative expectations. Sticking with tech, Wedbush out with its top AI stocks for 2026. Dan Ives writing, heading into 2026, investors are both excited and nervous about the AI revolution. 2026 is an inflection point year. Dan joins us now with his colorful self. Happy New Year. Wonderful to see you.
As always.
So let's talk about that. Why is it an inflection point? What do you mean by that?
It's really about, to me, it's about the second, third, fourth derivatives playing out across AI. Look, it's monetization. And you talk about Tesla, it's the next phase in terms of autonomous, robotics, consumer AI, especially when it comes to Apple, and I think what we're going to see. Look, I think it's a prove it year, but that actually makes me more bullish, because I think now we go into the next phase of AI. I think tech stocks are up 25% in 2026, but it's not just big tech, it's about second, third, fourth derivatives playing out.
I will be fascinated to see. I don't think anything is officially expected, but you're going to CES, right, which is not only the biggest tech conference in the world, but has become the most important car maker conference as well. It'll be fascinating to see if Tesla comes out with any other products there, or if we see a lot more robotics and automation products.
Yeah, and to your point, look, it all starts with the godfather of AI, Jensen. He'll be there with the black leather jacket, because when his speech, to me, is just so important on Monday, because it really starts off strategically what AI is going to look like. He's going to talk about physical AI in terms of autonomous robotics. I think the two best physical AI plays in the world today, it's NVIDIA and it's Tesla. And I think that speaks to you talk about like Tesla, what everyone's focused on. This is autonomous chapter now coming to Tesla. I think you see Musk right now, wartime CEO. That's the focus when it comes to AI, but also it's the monetization. Remember, only 3% of U.S. companies have gone down the AI path so far.
Are these robots expected to be like B2B robots, so building things in factories, or like a Roomba for consumers? What kind of products do you expect them to monetize?
Yeah, especially at CES, look, humanoid robotics is going to be front and center, autonomous. You'll see flying cars. A lot of the presence, you talk about a lot of the tensions between U.S. and China. The presence of Chinese companies is going to be, it's going to be a monster in terms of what we see there. I think doubling, over the last few years. But I think it's really going to be about humanoid robotics. It's going to be about autonomous, but this is also going to be about more embedded AI devices that consumers are going to see. CES, we're not just talking about flying drones and refrigerators that talk to you. Now these are much more sort of front and center in terms of it's a who's who. Every big tech player is going to be there, even if they're not unofficially there. They're there to look for acquisitions.
I love the idea of opening the refrigerator and having it say, do you really want that? And I can just imagine the future for, move over Ozempic. So there's this question here also about what some of the moves in late 2025 mean. And I'd love your take on this, because we saw some acquisitions made by the likes of Meta and NVIDIA. And I just wonder whether there's more cost consciousness and more of a competitive advantage that they're looking to solidify at a time where suddenly companies are saying, hold on, what are we paying for this, and what are we actually getting?
Look, I think you hit on a great point, because the reality is it's an arms race. That's what's going on with big tech. And right now, at the top of that mountain is big tech. And when you look at like Google's win versus DOJ, antitrust, this is sort of go time for big tech. And I think you're going to see more and more acquisitions. And we've talked about not just on enterprise, on energy, and I think really across the board. And it speaks to really what we're seeing right here is that it's not just about big tech getting bigger and bigger, doing acquisitions, spending. You're going to have $600 billion in CapEx in big tech, but it's also you're going to see other players being like, don't forget about me. Look at AMD. You're going to see look at Cisco, look at IBM. There's going to be a lot of other players saying like, hey, we want to get into that AI party. We don't want to look through the windows, like a lot of the bears are.
We were talking about BYD triumphed over Tesla to become the world's biggest electric vehicle manufacturer. We also have seen big tech in China outperform on an equity market perspective in 2025. Do you expect that to continue and for China to really solidify more of its neck and neck position with the U.S. or even supersede it?
Look, I think the reality is for the first time in 30 years, U.S. is ahead of China when it comes to tech. And I think that's very important, obviously led by NVIDIA, Microsoft, Palantir, and others. But in China, look, we're bullish on China tech. We talk about Alibaba, you look at Tencent, you look at a lot of the other names there. I think what you're seeing is it's a narrowing, but it's something where you're seeing robotics really play front and center, autonomous, EVs, BYD, and others in China. But when you think about how to play it, you have to play U.S. tech, and then there are Chinese tech players to go after. But in terms of AI revolution, like we've said, it's third inning, one out, relative to this AI game. And I think the bears, like I said, like in hibernation mode, they can see AI in the spreadsheets. And I think 2026 is going to be a year that's going to be another bull market year for tech and for AI.
I had really the same question as Lisa again, because we've seen so many stories this morning about Baidu's chip unit filing for an IPO, another chip designer, I think Breiner, with a very successful IPO today, maybe another mini DeepSeek moment, right, with a cheaper artificial intelligence, all among the most read stories on the Bloomberg terminal. So clients are paying attention to what's going on in China with AI. How do you bet on that? I mean, do you buy the individual stocks? Is there an ETF that you like? Do you have some of these stocks in your ETF?
Yeah, sure. So obviously, for the IVES ETF, I mean, what we really focus on is the AI 30. It's like, who are the 30 winners? We have a few of the Chinese players in there. I think Baidu, you look at Huawei in terms of the success they're having. Look, right now, NVIDIA's 4 to 5 years ahead of any other chip player. And I think that's well known. That's why even a third-rate H200 restricted, China big tech's going to line up despite what the politics in Beijing. But this is an arms race. It's the narrowing of the gap. You want to play some of those Chinese tech players. But the reality is in the U.S., from NVIDIA, AMD, we talk about our top five, Palantir, CrowdStrike, and cybersecurity. Tesla, I think it's going to be the most important year ever for them. Microsoft, I think on hyperscale right now, Microsoft, Oracle, those are names, I think, table pounders in my opinion in terms of what we see. And then Apple, finally, they come to the AI party instead of being on the treadmill at 2.0 speed. And now they actually start to get in terms of the consumer AI revolution, $75 to $100 per share.
There's only one company that you didn't mention that's on your list, and that's Microsoft. Where is Microsoft in terms of winning out versus Google? Who is its main competitor?
Look, in terms of Redmond, the enterprise, this is their backyard. When you think about companies that are moving to AI, the first phone call goes to Nadella. And I think you're seeing Google, you're seeing Amazon, what Jassie's doing. They're narrowing the gap, and they're going to be successful. But when I look at Microsoft, you have 25, 30 billion incremental monetization. I don't even think it's factored into street numbers. That's right, in the stock ultimately has a 6 in front of it. And I think this is going to be, we're going to go into January, into earnings season. I think that's going to be kind of the show me story, showing like, look, this is not stopping. Like we said, AI party started at 9 p.m. It's now 10:30, 10:45 p.m.
Me and Lisa are asleep.
Yeah, 100%. That's exactly what I was thinking.
But the party goes to 4 a.m. And that's where we are.
Yeah, I'll wake up when the party's ending. Dan Ives, wonderful to see you. It's always a good day when Dan Ives graces the door of Wedbush. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Bird and Lizzie.
Hi, Lisa. President Trump pledged in a late-night social media post that the U.S. will come to the rescue of Iranian protesters if they're attacked by Islamic Republic authorities. The post comes after protests erupted this week in Tehran after the currency slumped to a record low. Demonstrations have since spread to other parts of the country, setting off clashes between civilians and security forces. Elsewhere, Zohran Mamdani, a 34-year-old Democratic socialist, was sworn in as the mayor of New York City. Mamdani's campaign focused on affordability, promising to freeze rent on the city's nearly 1 million rent-stabilized apartments, make buses fast and free, and deliver universal childcare funded by raising taxes on the ultra-wealthy. Mamdani faces challenges, though, including maintaining the support of Governor Kathy Hochul and the state's legislature. And Shanghai Byron shares jumped nearly 76% in its trading debut. The AI chip designer's IPO marked the best first-day performance since early 2021 among Hong Kong listings that raised at least $700 million. This as China's tech sector boosts its efforts, as you were discussing, to strengthen domestic alternatives in response to US curbs. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, the strong US consumer.
Holiday season was solid. Consumers are cautious and discerning, but they'll buy what they don't have.
Eric Fish of HSBC joins us next to talk about what they don't have and want to buy and what that means about consumer sales in 2026. This is Bloomberg Surveillance. Good morning. Santa rally didn't really work heading into the end of last year, but the Santa rally still has 2 more days left, and right now we're trying to get off to a good start. We're seeing S&P futures up 0.6%, NASDAQ futures up about 1%. Taking a look at that 10-year yield, you are seeing a bit of a bid into bonds, but still more elevated than where we ended the year. 10-year yields at 4.15%. Yield curve steepening very much present. Crude was higher earlier in the session on concerns about geopolitics, whether it's Venezuela or Iran. Now a bid back in, or rather people selling crude once again, down about 0.33%. Under surveillance this morning, the strong U.S. consumer.
Holiday season was solid. The product newness drove demand, and with the K-shaped economy that we have, you're definitely seeing at the higher end and the lower end looking for value. And that's where you saw some of the traffic. Consumers are cautious and discerning, but they'll buy what they don't have.
Here's the latest. U.S. consumers showing resilience this holiday season, pushing retail spending up 4% year over year. Eric Fish of HSBC writing, confidence is holding. Strong employment and early shift in outerwear suggests shoppers remain optimistic, even if they're choosier about paying full price. Eric joins us now as the temperature in New York turns to be about 20 degrees out there. Fahrenheit, I mean, we're talking about outerwear. How come when the weather is warmer than expected in December, people say, oh, it's the weather that's causing sales to be low? And then when you have weather actually being cold and people go out and buy jackets, people say it's because the consumer is optimistic.
Yeah, you really need early shopping for outerwear to show optimism. So
Okay.
it's this year we really did see that. We saw consumers shopping in the fall. And that, to me, that's a sign of optimism because of exactly what you're describing. It's not cold yet. And you can always defer a coat purchase for another year. So it's a good sign. We did see that carry through all the way through December. So across categories, including outerwear, we saw strong sales all the way through Christmas.
They bought a jacket in October and then realized they needed another one because it is so cold out there. I do wonder just more broadly how you evaluate this K-shaped consumer and whether this strength truly is broad-based and whether it's sustainable in this year.
Yeah, we did see it across price points. So throughout the year, early in the year, there was a lot of pessimism around tariffs. And I think the retailers acknowledged that and responded by holding prices firm. And the consumer has shopped as a result. I think going into next year with the strong sales we saw, especially through holiday, I think retailers are going to be a little bit more aggressive in terms of recouping some of that lost margin.
How much do you have to pay attention to credit card APRs and how have they changed? Yeah. Because I imagine if the consumer is so rate sensitive when it comes to mortgages or car loans, that must be the same with credit card spending.
Yeah, I think the consumers that are building debt are not paying attention to those APRs. The stat that I look at the most is really employment. When you're gainfully employed and confident in your employment, you're spending almost regardless of some of those factors, and vice versa is also true. When you're concerned about your job, regardless of how much savings you have, you pull back on that spending.
So a lot of the items that we're talking about, outerwear, are high price items. Are these consumers buying these in cash? Are they borrowing, using a credit card that they don't know the APR of to buy these things? And does that matter?
Yeah, I think so. Credit card debt has risen, savings has decreased. I think it's generally in line with historical levels. We saw really an unnatural increase in savings through COVID, and that's reduced. So again, I don't have a concern about that specifically. employment is the key factor. And a slight uptick in unemployment, but I think it's holding where I think we'll see a confident consumer.
I see, by the way, the average APR at 21.39%.
Yeah. Is this something that you check as you spend a little bit more than you earn?
I don't use credit cards. I was burned as a college student, and I've never gone back.
Well,
But,
good to know.
Yeah, a lot of people do.
Maybe you can buy on credit at some point that kilt that you're going to be wearing at the end of this year. There is this question that you said that a lot of retailers are looking to make up the margins they lost at the end of last year. That's a really important point, especially ahead of that jobs number that we get next Friday. Is this prices increasing significantly? You expect that a lot of retailers have held off on raising prices through the holiday season, but are poised to do just that at the beginning of this year.
Yeah, throughout this past year, there was shared pain between the manufacturer, the wholesaler or the brand, and then the retailer, and a little bit on the consumer. I think all of those companies are now going to look to recover that. So we're going to see prices continue to rise. This holiday period was the last phase of product that was really committed to, manufactured, purchased, imported before tariffs, right? All of that was happening well before. As we go into 2026, people are going to want to have their historical margin rates. And so I think we're going to see all that built into the price.
Are we going to see manufacturing come back to the U.S.? I mean, this is kind of at least one of the points of these tariffs, right? We're all about deglobalization now. We don't care if we can get it cheaper elsewhere. We want it to be built here in America. And there's still, like, if I think of retail, only a few examples of like Filson and Schott. There's not a ton that's really made here.
Yeah, we're a far distance from T-shirts being manufactured domestically. I think what will happen is there will be shifts. So as you look at the tariff rates, companies are looking at them across different geographies, moving more production to Latin America, looking to diversify their supply chain. Absolutely. So I think we will see shifts. Nearshoring and domestic production, I think, is unlikely.
Eric, you're saying that we are going to see price increases. Can you give us some sort of rough percentage of what type of price increase we're expecting? Is it going to be 4 or 5%? Is it going to be 6, 7? Is it going to be 10 to 12?
I think
she had to slip it in. She had to slip it in,
and she warned me beforehand.
I know. Well, I've heard it's over. I don't think it's over. I'm
never really understood it to begin with.
It's nothing to understand. Anyway, could you let him answer the question? Let's move forward.
So what I would say is it's going to be all of those percentages for different products, and the reason is some products you can shift easily. So from a high tariff country to a lower tariff country, others, silks, cashmere, footwear, certain other categories are very difficult to move. There's a lot of investment that goes into building a factory. So I think those will see higher increases. There are also strategies people are using just to mitigate the tariff impact from an accounting perspective. So I don't think it's going to be the full impact, but it will vary depending on the category.
Eric Fish of HSBC, wonderful to see you. Thank you so much.
Thank you.
And yes, I did slip it in because I heard from our producer this morning that 6-7 is over, and now it's cream cheese bagel, which is, news in my household, but evidently that's the case.
Thank goodness neither of those have reached my home yet. I don't really get it, but I appreciate it.
It's not about get it. It's just sort of about saying it and then laughing. And it's a really good icebreaker at home when everyone's sort of quiet at dinner. 6-7, everyone's like, okay, Mom. And then they start to, anyway, let's move on. Coming up next, not that. Peter Shearer of Academy Securities, Mark Chandler of Bannockburn, and Dana Peterson of the Conference Board. As we head into a big week of data, we're finally going to get the first non-manipulated data, or I shouldn't say manipulated, but confused data post the government shutdown. We get the non-farm payrolls on Friday from New York. Good morning. Happy New Year. This is Bloomberg Surveillance.
That big story is really going to continue to be AI and tech.
I think you stay in a Mag 7.
It's still so early in this game that it's very hard to declare where the ultimate winners are going to be.
The same sectors that have been strong for a couple years before are going to continue to be strong.
It doesn't take much disruption to have quite a few domino effects that are going to impact the market in a more holistic way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we kick off 2026. Optimism abounding. Futures rising amid widespread optimism about the continuation of the three-year bull market. Big tech still the big focus, with Tesla reporting its fourth quarter vehicle sales later today amid questions about its membership in the Magnificent Seven, and heading into a big week of economic data, with analysts looking to January 9th for the first solid jobs report since the government shutdown. Matt Miller is with me today, this morning, which is a good and wonderful thing. John and Annmarie will be coming back on Monday. A question here about the optimism that everybody has on Wall Street. Does that make you, Matt Miller, sitting in that seat, more pessimistic?
No, I'm not pessimistic. I'm just skeptical of these one-day moves saying something about 2026. I am optimistic about the broader technology of AI. I just checked my screen usage, and I've been on ChatGPT for an average of 3 hours and 1 minute a day over the last week. So
you have? Asking what?
It's incredibly useful for me, whether I'm working on my motorcycles, whether I'm doing something in the car, whether I'm, well, those are the two things that I do, you know. It really is helpful. I actually used ChatGPT to help fix my boiler. It identified an igniter coil that was out and helped me order a new one. And I used it to help fix my oven as well over the last week.
Matt Miller, who is getting royalties for his ChatGPT use. Just kidding.
I also use Gemini.
Okay,
I also
all
use
right,
other
there we
platforms,
go. Meanwhile,
but,
you
yeah.
see that kind of optimism really percolating through to some of the tech names this morning. You are seeing them reprise their leadership, which raises the question of what is going to be different in 2026 about the tech trade. We were just speaking with Dan Ives about that. And honestly, that is going to be one of the key. Can you, Matt, see that broadening out that you saw at the end of last year if you see the adoption of some of these tools where people can, manufacture their motorcycles better?
Yeah, I wonder if it comes through in healthcare. I wonder if it comes through in education. These are obviously the things that we hear from guests every day, but I don't know if I've seen it yet. And that would be great for not only society, but also for the stocks.
Which is the reason why maybe today you are seeing a bit of outperformance in the Magnificent Seven, with the NASDAQ futures up about 1%. I take your point, Matt. Typically, the first day of trading doesn't really mean much. You do see in bonds a little bit of a bid into the fixed income space after the best year going back to 2020. A question of where the outperformance is. It is in the belly of the curve. It is in the 10-year yield, 4.15, down about a basis point. The 30-year yield still sort of pegged at that 4.84% level. And in the metal space, you have seen such a huge rally over 2025. Best year for gold and silver going back to 1979, continuing with that trend. Silver back on its volatile trend. You see 3.5% gain on silver. Aluminum crossing that $3,000 a ton mark for the first time going back more than 3 years. Coming up this hour, Peter Shear of Academy, with stocks poised for a strong start to the new year and a big pro-sec focus. Mark Chandler of Bannockburn following the dollar's worst year since 2017. And Dana Peterson of the Conference Board looking for a clear read on the economy. We begin this hour with stocks higher following 4 days of losses. Peter Shear of Academy writing, we need to make sure we pay attention to the rest of the world. There were a lot of opportunities around the globe last year, and there will continue to be going forward. Peter joins us now. Peter, great to see you. Happy New Year.
Happy New Year, too.
So you talk about the rest of the world focus. Is it at the expense of the U.S.? Is it only if you do see the dollar continue to weaken?
I think the weakening dollar is going to continue to be a story. I think that's going to be a big role in this. But I do think emerging markets could do very well, especially Latin America, South America. I think we have turned our attention to Latin and South America. Look what we're trying to do with Venezuela. Assuming that is successful, I think then we turn our attention to working with Mexico on their cartels. So I think there's a huge opportunity within that space for more and more business. And again, I know we've been talking about America first, but we're not talking about America only. So I think as we try and build out these industries, these things that we need, there is a dawning realization within the administration. We are going to have to work with our close allies and friends, and close can both mean, physically as well. So I think Central South America is going to be a beneficiary. So I like that part of the world best. And Europe's going to have to figure out something to do. I think Europe's going to be a bit slow on the uptake, but I think they're eventually going to figure out this production for security and rebuild their industrial base as well.
You're bullish on Latin America. Some of the changes you're thinking about could go either way. And I think a lot of people feel some level of ambiguity when you start talking about Nicolas Maduro and regime change over in Venezuela, and you start talking about a question of whether this is going to be a benefit or whether it's going to be a detraction to some of the production in some of these areas. I'm just wondering, why do you see it as an unabated opportunity, even at a time where the U.S. and China seem to be tit for tat in South America?
So I think that's a great point on China. One, I think, look what we're doing with Argentina, right? We provided the swap lines. We are going to try and rebuild our foothold into Argentina. I think we will be successful in pushing the drug trade out of Venezuela, slowing that down. And then again, I think that will quickly turn our attention to the cartels with Mexico, working with or without Scheinbaum to push on that. So I think you're going to see a lot of good coming out of that. The other thing you are going to see is this ongoing friction between China and the U.S., whether it's oil in Venezuela, whether it's oil in Iran. And I think, Dan, I've talked a little bit about this, but I think there is going to be real competition between the U.S. And the one thing I don't love about this morning's rally is like, oh, we're starting because of all the success of Chinese data centers and Chinese AI chips.
Yeah.
I don't think that's positive for the U.S., to be honest. I think we're in real competition.
That was exactly my read this morning. I mean, we're rallying. All these U.S. AI companies are trading higher in the pre-market because China's doing better. Makes very little sense. I also think it makes very little sense that we're going to somehow stop the U.S. drug problem by working on the supply issue. I mean, don't forget, the reason that we have a drug problem is because we demand to use these drugs, right? American buyers are the main issue here. Does Prozac have any, a change in that?
No, but I do think we're seeing kind of law and order. If you look at the recent outrage over potential fraud in Minneapolis, right, whether it's true or not, you're starting to see kind of this concept, I think. And you look even San Francisco. I have not been there in the last 6 months, but I've told it's night and day. They've really been working on cleaning up. And I think a lot of what we have to do is just enforce the rules that were in place. We, for years, chose not to enforce the rules that were in place. I think you start putting that back, that shuts down a little bit of the demand, or at least the ability to get that demand filled. So I think it's all working in conjunction.
Right. I feel like the Sackler family is still doing pretty well, When I think about your Prozac thesis, I really think about Intel the most because, one of the big problems we have is that all of our chips that we need, that we're reliant on, are made in a territory claimed by China, right? What are we going to be able to do about production here in the U.S.?
So, normally I don't talk about single stocks, but we made the exception with Intel.
Okay.
But we made, because I think it is going to be such a key part of this, right? I think the fact that the U.S. government put 10% into that is going to encourage Trump and the administration to try and drive business Intel's way. And again, I think if we're right on this Prozac, so this is all about resiliency, right? It's like, how do we produce things for our own security? There's going to have to be more and more domestic. I think there are other U.S. companies on the chip side that will do more and more here. I think just because of that investment the government made, Intel is going to be a big beneficiary. Look for more and more deals to be announced. Their technology is good. It's getting better. I think that is going to be one of the key growth areas. I know it was up 80-some-odd% last year. I think it does extremely well this year. And that's probably my favorite pick within the data center AI because it fits so perfectly with our production for security as well as the AI growth story.
Well, how much is it going to be government support and how much is it going to be actual ground up success in the business model, right? I mean, does this sort of national selection of champions work when it comes to success in business?
I think it can. I think, one, the U.S. is just a massive consumer. So if the U.S. starts encouraging people, hey, we want to buy stuff, but we would like Intel inside, that makes a difference. I don't know whether it's the way we should go about it or not, but I feel that that's the way this administration may go about it. And separately, I think the technology is good. So sometimes if you just need that little nudge, maybe that's what occurs here. And again, I think they've been doing a lot to do this. They are seemingly, I think, getting better at separating their chip design business from their chip manufacturing. And I think we are just at such this early stage of people really thinking about Prozac or production for security or resiliency that there's a lot more going on. We're going to see this. We're going to see this through the electricity industry, whether it's nuclear. I just think, and again, this is an administration that is well aware that if stocks are not doing well coming into the midterms, it does not bode well. So look for lots of pushes to get the stock market going.
We see this right now in the metals trade. We just saw the best year for gold and silver. You could say gold is a precious metal. It has to do with something about the de-dollarization and something other than some of the industrial uses. But we see it in copper. We see it in aluminum. How much is this just the beginning versus the end salvo that we see in this trade?
I think it's at the very early stages of this because one, and I admit, right, I think if we're going to try and build factories, if we're going to try and do some of these things, again, we're not going to try and produce everything ourselves, but we're going to try and produce more and more. Those are 2 to 5 year plans in many cases. In the electricity space, it could be 3 to 7 years. Steel, aluminum, right, 3 to 10 years. the build out of those factories and those facilities, it's going to put huge demand on commodities, right? You are going to need commodities. You're going to need the cats. You're going to need the deers, the Navistars of the world to build out those. So I think you're going to get the job growth, not from the actual end facilities right away, but from the build out. And that's just starting.
Doesn't that speak to inflation? Doesn't that speak to something that people have basically shrugged off as a significant risk in 2026?
Yeah, I think we're going to have a steady pace of inflation. I think it's going to be there. I think the only thing offsetting that is going to be there is going to be some deregulation in the U.S. in terms of a lot of the mining, and I think that will help keep a lid on some of the commodity prices. I think it's going to be hard on things like copper, where we don't have much. I think oil and gas are going to remain relatively cheap, particularly oil this year. So I think that will help offset some of this. I see inflation kind of being this steady state problem. And again, I think it's going to be persistently in that 2 to 4%, probably hovering around 3%. I think tariffs start taking a bit of their toll. I think your last guess was spot on, where I think people forgot how much was front run, and we're only starting to see that bite. We're only starting to see people like, hey, we've used up a couple of quarters of maybe we had some things that we could play around with, and now it's like we're back to business. We need to make our margins. So I think that's going to be an ongoing state. So I think it's going to be hard for bond yields to do great this year. On the other hand, I think they're going to do okay.
Peter Scheer of Academy Securities is going to be sticking with us, which is a wonderful thing. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hi, Lisa. Accusations emerging following the deadly train crash near Peru's Machu Picchu earlier this week. A subsidiary of LVMH is blaming a train company majority owned by global private equity firm Carlyle Group for the crash. In a letter to the Office of the Prime Minister, the company said Carlyle's Inca Rail transited through an unauthorised part of the tracks, leading to the head-on crash. Inca said that it's cooperating with authorities and warned against jumping to conclusions before authorities have weighed in. Elsewhere, Ørsted has launched legal action against the Trump administration following the suspension of its $5 billion wind farm project. The energy supplier says that the decision, quote, violates applicable law and will call for the suspension to be lifted until the court hands down a final verdict. This is the second time that Ørsted's Revolution wind project has been targeted by the Trump administration. Finally, staying with the president, Trump offering an explanation for visible bruising on his hands. The president telling the Wall Street Journal that he takes a higher dose of aspirin than his doctors recommend. Trump explaining, quote, they say aspirin is good for the thinning out of the blood, and I don't want thick blood pouring through my heart. I want nice thin blood pouring through my heart. That should be my brief. Lisa.
Thank you so much, Lizzie. Up next, increasing the pressure on Venezuela.
Not going to let anybody going through that shouldn't be going through. You remember they took all of our energy rights. They took all of our oil from not that long ago, and we want it back. But they took it. They illegally took it.
Bloomberg's Tyler Kendall joins us next as that whole region really heats up. From New York, this is Bloomberg Surveillance. Good morning. Right now, we are seeing gains to start 2026 on a positive note. With the same leadership as we ended 2025, we are seeing an outperformance in NASDAQ futures up about 1%. We're seeing a 0.6% gain on S&P. You are seeing a bit of a bid into the bond space, building on the biggest year going back to 2020. The 10-year yield, 4.15%. A real question, as we've been talking throughout the morning, about inflation and whether that will come back to bite. And crude prices on that inflationary point, not really adding to any kind of price increases, down about 0.5%, despite some earlier volatility, $57.17 traded on the NYMEX. Under surveillance this morning, increasing the pressure on Venezuela.
Not going to let anybody going through that shouldn't be going through. You remember they took all of our energy rights. They took all of our oil from not that long ago, and we want it back. But they took it. They illegally took it. We had a lot of oil there. As you know, they threw our companies out, and we want it back.
Here's the latest. The Trump administration sanctioning Chinese shipping companies and their oil tankers in the latest strike against Venezuela's crude exports. Bloomberg's Tyler Kendall joins us now. Tyler, thank you so much for being back with us. Is this about drugs? Is this about regime change? Is this about oil?
Yeah, hey, Lisa, good morning. Well, it depends who you ask in the administration, because it really seems like all answers are pointing to all of the above. And it's interesting to point out that we did get a new analysis out yesterday from our analysts at Bloomberg Economics, who say that it looks increasingly likely that we will see an exit from Nicolas Maduro this year. They also point out, though, that the issue with pressure campaigns, particularly from the U.S., is that until the intended goal is achieved, there is really only one way forward, and that is up the escalation ladder. Now, this latest move is being viewed as a warning sign by the administration to China, which goes to the question about oil. They are, of course, the largest importer of Venezuelan crude. Data shows us that Venezuela, on average, exported 750,000 barrels per day last year, and nearly half of that went to China. Now, at this point, we've seen China come to Venezuela's defense, but experts say that's really, for the moment, going to remain in the rhetorical camp for now, even as Beijing raises questions about the U.S.'s own seizure and the legality of these seizures of these oil tankers. So it's something to wait and see. But, of course, our reporting has indicated, Lisa, that there is a broader plan here when it comes to squeezing that oil lifeline for Nicolas Maduro.
Taylor Kendall, thank you so much for being with us. As always, and a real focus on Latin America. We were just speaking about that. And we'll continue the conversation with Peter Scheer, head of macro strategy at Academy Securities, who is still with us. Peter, we're talking about how you are optimistic on Latin America. How much do you see it, though, as ground zero for the international disputes, whether it's the U.S. versus Russia, whether it's the U.S. versus China? I mean, how much is this the new ground zero?
Yeah, I think it really is. And I think three things kind of we've been talking about will really resonate with this particular story. One is it's about law and order, right? Enforcing sanctions that have been on the books for a long time. We chose not to, enforce those sanctions. You start putting that on. I think the other thing people are missing, and it's starting to come through loud and clear, is whether it's in Russia and Ukraine, whether it's in Venezuela, to the extent there are peace deals, Trump is going to do everything in his power to get U.S. companies a big advantage in the rebuilding. So look for that to play a big part of the U.S. growth story, is whether it's peace in Russia, Ukraine, anything in Venezuela, U.S. companies do phenomenally well. And then finally, it's just going to be friction everywhere with China, right? China was able over the last 2 decades to kind of set their tentacles into all these countries across the globe. They used their Belt and Road Initiative very effectively. And now we're going to be pushing them out. It'll be really interesting to see what China has to say on some of this. And weirdly, China's been incredibly quiet on Russia. All these pictures over the past few years, Xi and Putin, best buddies, that are going to work together. He's been very quiet. So I want to see where all this plays out. But I think when you were looking at this, whether it's from a shipping perspective, where you want to build your new plants, you have to be focused on Central and South America if you're an American company, and a little bit reluctant to be too invested in Southeast Asia right now as the U.S. turns its attention, in kind of the Monroe Doctrine too.
Yeah, I was thinking that as well. It's pretty interesting that President Trump has put his own spin on the Monroe Doctrine. When I look at China, and I could be wrong here because I'm so focused on the auto industry, I see the rare earth minerals as their biggest advantage over us. They have the mining and refining capabilities that we just don't have, right? MP Materials is a very small company. How do we turn that around? And am I right that it's so important?
Yeah, I think it's very important. One, I'm much more focused, and I think when we talk to the administration, they're much more focused on the refining and processing, right? China controls about 60% of the extraction of the rare earths and critical minerals, so there is the ability to buy it on the open market. It is going to have to come down to the refining and processing of this. One, I think it's going to take deregulation. So we're aware that some states are actually going to be trying to be very favorable to encourage some of these businesses to grow, right? Because it's been something we avoided. It's going to take time. It's going to take deregulation. It might take some government investment. Those are the directions headed. I think we need to start. And when I look at this battle between the U.S. and China, I feel that China's sitting there trying to say, we want to catch up on chips, but our lever of power is these processed and refined, rare earths and critical minerals. How do we weigh on that? And they're balancing, can they catch up on chips? And what I'm mostly afraid of is that we go through these negotiations, and as far as I can tell, there's still no final deal. Both countries are like, hey, when we're back 2 years, we're going to be in better position. For us to be in better position 2 years, we need rare earths and critical minerals processing and refining done here. For China to be better, they need to catch up on AI. A little bit worried China might beat us, but I think that's the game that's being played. I see a sense of urgency that's occurring with this. I see that government investing. And again, I think you start talking to private equity companies, right? They're now scouring, through companies. Who's got mining rights that have been ignored? Who has maybe some interesting patents or technology that we weren't using when we couldn't produce lithium dioxide as cheaper? So I think this is all just starting. People are going to cover it. And what's to me is really exciting is, yes, the U.S. government kind of jump-started this process. It's U.S. capitalism that's going to drive it. U.S. capital is going to see, hey, there's opportunities. We can make money on this kind of pro-sec concept, building these things out in competition with China. That's going to flow through, and I think you're going to see corporations adopt that behavior as well.
But the deregulation part is really key here, right? And that's been a problem not only for rare earth minerals refining, but also for power generation. I mean, try to run a power line from your plant to the end user, and good luck. It's going to take like 14 years to get those licenses. How effective can the Trump administration be in this deregulation?
You know, I think reasonably effective. I think, one, you're going to find some states that are very pro-business, that they want these things. They want to see the growth in their state. They want to see the tax revenue. They want to see the job. So I think you're going to see some, red states, probably in the South, do very well, that they are going to accept deregulation. They'll embrace it. Even California, in some parts of it, saying, hey, we need some of these things. That California is exploring, right? I think there's this realization that we went too far on regulation. Having said that, I think some states are going to fight this. It's going to become an election issue. There's going to be that certain crowd on all of these things, unfortunately, where if Trump says something, 1/3 says that's the greatest thing ever, 1/3 says that's the worst idea ever, and we lose the dialogue. So I think we need the dialogue. We need this. But I am encouraged. What we're hearing is some states really going to be aggressive about this. That will let it go. And I think even with the data center and AI, right, there's going to be a bit of a realization that, to me, things that don't require low latency, so some of the technology can require higher latency, it's going to move to the states that are most conducive to allowing electricity production. It may move even closer to the source. I see a world where you see some of this look a little bit like oil rigs. You get shipped to your data center, you work there for 2 or 3 weeks, you get shipped back. So we're going to change where these data centers go, especially for the things that aren't low latency.
Are you worried about regulation on AI? You mentioned China a couple times already this morning, and the potential that it could beat us on AI. Regulation has to be a key part of that, too, and a lot of people are going to start pushing for it.
And I think we've done a pretty good job in terms of that. I think, Europe's a mess, right? Europe has so much regulation, all the privacy issues, they're going to get nowhere on AI, plus they don't produce any electricity. So not worried about Europe, much more worried about China. Also, India, I think, has a real potential to become a burgeoning player in this space, right? NVIDIA's moved on, equipment there, right? It is a really interesting play. I think we've got to be very careful on the regulation, and I agree that there has to be regulation because you see some crazy stuff, as I think you guys are reporting over the weekend. Having said that, I think we've got to be careful not to limit ourselves too much. The other wild card to me is the Middle East, right? I think in many ways it's great that we're selling chips to the Middle East. On the other hand, I'm not sure we really want them to become a data center or AI capital of the world.
You're talking about becoming more resilient. How do you know what risks to become most resilient against? What are sort of on your range of risks that companies should be watching out for?
And, to some extent, you just go back to first principles. What do we need, right? And let's say if China shuts us off from rare earths and critical minerals, how quickly does half our manufacturing or finished products? Very quickly, right? Even if they shut off our Chinese factories or Indian factories from getting those. So, okay, boom. Let's fix that. Let's make some level of these so that we have months and months of supply without China. I think you look at the data center and AI with chips, right? If China was to do something to disrupt even shipping out of Taiwan right now, very innocuous, very gray zone type things that they could do with their maritime militia, what happens to our industry? Bad. So we need chips. So I think that's kind of, you look at it, it's kind of, when I go back to even sustainability, right? I think one of the things maybe that was made, you look at what humans need, right? We need air. You don't live without air very long. Then you need water. You don't live without water. Food, you can actually live a decent amount of time without food, relative. And then with higher temperatures and stuff, you can live a long time. So I think when we're looking at this, I'm kind of looking at the industries. What do we need to be sustainable and resilient? Let's pretend that China wants to be bad. What would China do to try and hurt us? Let's make sure they can't. It's deterrence on an economic side. So on the military side, right, you have the big missiles to make sure that they don't want to attack you. Yeah. On the economic side, you do the same thing. You make sure that you're prepared for them.
Peter Scheer, wonderful to see you. And now I'm looking at ChatGPT. Go bag. What should be in my go bag? Peter Scheer of Academy Securities. Always great to see you. Coming up in the next half hour, Mark Chandler of Bannockburn as the dollar aims for a positive start to 2026. Plus, Lizzie Burden is back with your morning movers. Tech very much in focus. This is Bloomberg. Trying to end up in a better place at the end of the first trading day of 2026 than where we left off. We are seeing gains in futures across the board, led by big tech, up almost 1% on the NASDAQ futures. S&P futures up about 0.6%. You are seeing a rally into the 10-year. You're seeing right now 4.15%, down about a basis point after earlier seeing a pretty significant sell-off. So volatility in this space following the best year for the global aggregate bond index going back to 2020. And silver still on a tear, up 3.6%. Last week was wild. I say last week, but I'm saying the 3 past days of trading, Matt. It seems like silver very much in focus in metals volatility.
Yeah, absolutely. I mean, the run-up that silver had last year was historic. You know, I can't remember exactly where we closed at New Year's Eve.
148%.
Okay, 148% is amazing, and it's twice what we saw with gold. I think it's even more interesting because there's so many more industrial uses for silver than there are for gold, right? So it's obviously not just about jewelry, but it's really one of the defining stories of 2025.
Are people buying silver bars now, in addition to their gold bars at Costco? 2 hours away from the cash open, here are your morning movers with Lizzie Burden. Lizzie.
Hey, Lisa, I want to start with the Mag 7 because it looks like traders are still in buying mode this first day of the year. We've got Nvidia up 1.6% right now. We saw 25% gains for the Mag 7 as a whole across the course of 2025, and so far it looks like it's continuing. Let's flip over, though, to aluminum because that, as you say, is up past $3,000 a ton for the first time in over 3 years. You've got supply factors here when it comes to China and Europe, but also long-term demand bets when it comes to sectors like construction and renewables. So the likes of Alcoa this morning up over 2%, riding that wave. Let's go back to the Mag 7, though, and focus in on Tesla, because, of course, we're expecting their Q4 production and deliveries report out later today. Analysts expecting a drop in global vehicle deliveries of 11%. But don't forget, earlier in the week, Tesla took the unusual step of pre-releasing its own analyst estimates average, and that was even more pessimistic, a 15% drop. So that disparity perhaps explaining why you're seeing Tesla up 1.4% in the pre-market. Lisa, back to you.
Thank you so much, Lizzie. On our radar this morning, President Trump saying the U.S. will intervene if Iran starts killing peaceful protesters. Trump saying on social media the U.S. is, quote, locked and loaded and ready to go. Widespread protests erupting in Iran over economic hardships and a falling currency. Meanwhile, President Trump delaying tariff increases on upholstered furniture and kitchen cabinets as voters voice more concerns over affordability. The U.S. also reducing controversial anti-dumping tariffs on some Italian pasta brands. Wasn't on my bingo card, but the idea of reducing tariffs has been something that we have seen in a number of different venues, Matt, and this is even before any kind of IEEPA case.
Yeah, because of the last elections that we had in November and the wins for Democrats in places like New Jersey and Virginia on the affordability campaign, this administration has pulled back a bit on some of its tariffs, obviously playing to do better in 2026, right? When voters go to the polls, again, it makes perfect sense, but it's also, in a sense, admitting that tariffs do to some extent drive inflation, which is one of the things that they were adamant about not being the case before the last election.
Yeah, and inflation is going to be very much in focus, especially considering the fact that people do think that inflation is in check enough for the Federal Reserve to cut rates. It seems like tariffs hasn't been something that is considered inflationary so far, and maybe will continue to not be as much if you do see a backing away from some of these tariff things, even before the IEEPA decision, which is expected in the next couple of weeks.
Right. I think, one of the other important points is that wages have kept up with inflation, at least if you look at a longer-term average. Torsten Slok of Apollo was putting something out about that earlier this week. And I think that's interesting because you can deal with a 3% inflation if you're getting 4 or 5% more in your paycheck, right? But the question is, how much longer does that stay the case? And how much longer is the Fed willing to deal with a target or an inflation number that's 50% higher than its target?
Next Friday, we do get non-farm payrolls for the month of December. Watch this space. Meanwhile, New York City has a new mayor. 34-year-old Democratic Socialist Zoran Mamdani was sworn in outside City Hall yesterday Mamdani promising in his speech to deliver an agenda of, quote, safety, affordability, and abundance. And Matt, you're talking about the midterm elections. How much is Zoran Mamdani the mainstream now and, frankly, the face of the Democratic Party, or is he the outlier in terms of the Democratic Socialist while a more sort of centrist party takes over?
Yeah, I mean, he had all the outliers with him at City Hall, right? He had AOC there, he had Bernie Sanders there, and I think there was a lot of bark, but I'm not sure how much bite there's going to be. Universal health care, free child care. These are very expensive things that the New York City government alone can't pay for. They need New York State to help. And so far, it doesn't look like Kathy Hochul is going to step in.
Yeah, it's a great question, and we're going to all be watching that unfold. Turning back to markets, traders betting on more U.S. dollar weakness. After the greenback ended last year with its sharpest drop since 2017, Mark Chandler of Bannockburn Global writing, the dollar is still terribly overvalued, and the multi-year decline is set to continue. Mark joins us now. Mark, thank you so much for being with us. Happy New Year. What do you mean that the multi-year decline is set to continue? Why do you see this as a long continuum rather than a particular year of 2025?
Happy New Year, Lisa and Matt. So I think that, when I look at a chart, I think the dollar index itself, this basket that the dollar trades against, peaked in 2022. And so I think that what we saw last year was sort of the dollar's decline has begun, and it's really what we're talking about is just a different pace of it. And so last year, I think that we saw the dollar decline really was a first half story as the market adjusted to the new Trump term and the tariffs. But I think as Matt has talked about with these upholstery and vanity tariff relief, that the bark was worse than the bite. Since the Liberation Day, we have seen the U.S. effective average tariff really come down by almost half. And we haven't seen many other countries retaliate. For me, the key driver of the dollar is going to be the Fed policy, and the market's looking for at least one cut, maybe it's two cuts, largely discounted. And I think that we'll see 2 to 3 cuts next year by the Federal Reserve as the economy does slow.
So you think that there's going to be about a 9% decline in 2026, which is commensurate to what we saw in 2025. How much is this driven by one particular cross, or is it broad-based?
I think it'll be broad-based. I mean, of course, the yen is lagging a bit, which is a bit of a surprise given that the central bank has been hiking rates. I think that since the Bank of Japan hiked rates, the threat of intervention becomes more potent. I think that intervention before they hiked rates would have probably faced criticism from the U.S.
I'm interested, Mark, and by the way, Happy New Year to you as well. Great to see you. I'm interested in your comment on the economy and your expectation for growth to slow, especially as we have this one big, beautiful bill kicking in. Aren't we going to see corporate tax cuts? Aren't we going to see, retail tax cuts help to spur more spending and investment?
I think you're right, Matt, that at least in the first quarter of the year, we're going to get those corporate tax cuts. We'll get large refunds as well for U.S. households. And that could help buoy the economy in the first part of the year. But the real weakness is likely to come in the second half of the year. And I think that what we'll see as well is unemployment rates tick up. The household sector, I really buy into this K-shaped state of the economy, where the growth is concentrated, consumption's concentrated. Most households have debt stress levels, measures rising. And so I think that this sort of bifurcated economy is ultimately going to be a drag. And so that's why I really think that we'll see the Federal Reserve have to cut interest rates further.
How do you think about the labor pool when looking at unemployment, Mark? Because we had obviously an explosion of immigration under President Biden that's now dropped back to zero, and demographics are going the wrong way. So it's not like we're getting really many new workers as corporate profits continue to grow by double-digit percentages.
I really accept Powell's description of what's going on. We've got a low hiring and low firing type of labor market situation. But, we did have distorted data where there was the healthcare spending that helped lift consumption in Q3 GDP. Or whether we see the concentration of consumption into the, say, top 20% of the income profile. So, yeah, I'm concerned about these things. But in general, I think that the labor market is just grinding lower. And despite the efforts to help protect the U.S. manufacturing sector, We continue to shed manufacturing jobs.
What do you think about wages keeping up with inflation? I continue to reference Torsten Slok's chart, but he has a 6-year average there. And it doesn't feel to me like wages really have kept up with inflation, certainly not through the Biden administration. How does it look to you when you look at the data?
Yeah, so I think that, it's funny. Everybody talks about CPI. Countries talk about CPI. Many of them target 2%, but we all measure it differently. And I know my household cost of living has gone up by more than 2% this year, more than 3%. I think about the groceries, how much the dollar buys of groceries these days. And so I do think that American households are being squeezed. And I think that debt, credit levels have increased to help make ends meet.
I'm just wondering, Mark, to close up the conversation, we're talking about the currency and we're talking about rate differentials and we're talking about the traditional things. Is there something new happening? And I ask this after gold and silver just had their best year since 1979. Is there a global shift away from fiat currencies toward real assets in a new kind of way than we've seen in the past?
Might be, Lisa. I think that you're right that, we've seen not only gold and silver, but a lot of the industrial metals as well. And I think partly this is what's going on as a weaponization. I think this is, January 1st, China put on silver controls, silver export restrictions. And in the U.S., we moved silver from just like a normal metal to a critical or strategic metal. And so I do think that there's a change taking place. In my work, I think that the U.S. has recognized, I think in Trump's own idiosyncratic way, he's recognizing, and his phrase, G2, meaning the U.S. and China, that the U.S. is no longer this hegemonic, unchecked power in the world, and that China is a real demand because it's the factory of the world. China is making about 30% of the world's manufactured goods. In 1950, the U.S. accounted for about 60% of the manufactured goods. Within about a decade of that, the U.S. had really become a trade deficit country, a chronic trade deficit country. And so I think that the tectonic plates are shifting. I'm not convinced, though, that gold or silver are going to really replace the dollar. I think part of it is people like myself who see an uptrend in gold and silver and want to participate in it, leaving aside the geopolitics and the shifting tectonic plates.
Mark Chandler of Bannockburn, wonderful to see you. Thank you so much for being with us on this first trading day of the new year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Gold and silver are rallying in the new year, building on their best annual performances since 1979. Goldman Sachs saying its base case is for gold to rally to $4,900 this year, with risks to the upside. And aluminum touched $3,000 a ton for the first time in more than 3 years due to a tightening supply outlook and bets on long-term demand. Elsewhere, rising healthcare costs are a pressing issue for millions of Americans. As of New Year's Day, enhanced tax credits that cut premium costs for the vast majority of people with Affordable Care Act plans have expired. An analysis from the Urban Institute and Commonwealth Fund projects 4.8 million Americans will drop their coverage without the subsidies. And finally, in sports, the college football quarterfinals took centre stage over the holiday. In a New Year's Eve stunner, Miami shocked the defending champs Ohio State 24-14. Meanwhile, top-seeded Indiana remained perfect, crushing Alabama 38-3 in the Rose Bowl. Elsewhere, Oregon shut out Texas Tech 23-0, and Ole Miss outlasted Georgia in a 39-34 thriller. And that's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. Really appreciate that. Did you watch that with
Ole?
Ole. Well, it's fair. I mean, she's in London. I just know it's Ole Miss. Anyway, I totally get that. Did you watch that? Were you keyed in on the games?
Unfortunately, I did watch the Ohio State loss, and it was painful. It really hurt.
Close to your heart.
And I've seen bad Ohio State losses to Miami in the past, and it still didn't make it any better. It was tough.
Well, it's a new year, so maybe it's a new future for Ohio State. Up next, new year, new data.
Reading these data is much harder at the turn of the year than, say, in the middle of the year. The tenor of the data in general is pretty good. We still need the labor market to pick up, but the ingredients are there.
Dana Peterson of the Conference Board joining next. This is Bloomberg Surveillance. Good morning. Happy New Year. It is a new year with a new tone in markets, at least in the last 4 days of 2025. You do see a lift to equity markets across the board. NASDAQ leading the charge, up 1%, followed by Russell 2000 futures up 0.7%, S&P up 0.6%. Are we going to see that broadening out this year? The big question for so many different stock investors. A lot of it has to do with what's happening here, 2s, 10s, and 30s, whether we get that bid into bonds, continuing to lift this idea that smaller companies and more leveraged companies continue to outperform. We do see that bid continue. 30-year yields down 1 basis point, 10-year yields down 2 basis points to 4.15%. So much will hinge on what the path of the Fed looks like, and so much of that will rely on some of the information that we get later next week. Under surveillance this morning, new year, new data.
Reading these data is much harder at the turn of the year than, say, in the middle of the year. What we're looking for are signs of more stability in the labor market, signs that the hiring rates start to pick up off their very low levels. The tenor of the data in general is pretty good. I mean, solid. There, like I said, we still need the labor market to pick up, but the ingredients are there.
Here's the latest U.S. data blind spots weighing on economic forecasts in the new year. Dana Peterson of the Conference Board writing, 2025 is ending on a confusing note for markets, economists, and central bankers alike. Still, we should not completely ignore the data. Dana joins us now. Happy New Year. Thank you so much for being with us. Dana, let's start with the data that we have gotten. Why is it so noisy? How should people look at it, considering that people do view it as somewhat noisy, but also they can't ignore it?
Exactly. You can't ignore these data. We did have data for the third quarter. Certainly the GDP came in a lot stronger than expected. And certainly consumption was a lot stronger, even though we did have data. It shows that the Federal Reserve, it shows that the federal government probably had more data in between releases and certainly after the shutdown. But I think the key thing is that inventories and trade were very confusing. And indeed, when you add up the inventories, when you add up the imports plus the consumption, the inventories numbers just don't make sense. So we really need to get data next week on inventories as well as international trade, business sentiment, and also employment. I think we really need to see more data to get a handle on what happened in the third quarter and also what happened in the fourth quarter.
Dana, we are going to get some data come next week that is going to be important, including the non-farm payrolls as well as some of the manufacturing aspects that you're talking about. Nonetheless, we have a host of other information out there that people keep pointing to, whether it's ADP, whether it's earnings, whether it's the rhetoric coming out of a lot of companies, or whether it's retail sales. I mean, is there some sort of conclusion that you can take even amid the noise?
Well, I think, certainly the stock market does not reflect the real economy. So we can't look to that. And also most people don't own stocks, so they're not really benefiting from that. We do have lots of sentiment data. Of course, our consumer sentiment data has shown that consumers are less sanguine about the current conditions, as well as having some concerns about the future. Retail sales, all we have really is the end of the third quarter, and they were weaker. So I think that we just need more information, and you can't look at these things and try to estimate what the government data is going to tell us.
I'm looking at the Conference Board Consumer Confidence Index, and it hasn't been this low since the pandemic. So what does that tell us about, inflation, growth, spending?
Well, I think the inflation bit has yet to hit us. Remember, the tariffs that were implemented were delayed twice, and also they were raised and lowered several times. So many businesses are still waiting to see if there's any certainty with respect to tariffs. Yes, we've had a number of deals established, but there's still a lot that's unknown. And so with businesses uncertain, it just means that we're not going to see much hiring. We're not seeing layoffs, which is good. Most people still are working, but those who do get laid off are finding it very difficult to find jobs. And even though most consumers are working and they actually are spending, the type of spending that they're engaged with is very different. They're buying things that they need. And when it comes to, especially with goods and services, and when it does come to things that are entertaining, they're buying cheap things, right? Cheap thrills like streaming instead of going to the movies and paying, over $100 for a family of 4. And so I think we need to really get beyond the first quarter of this year to really see what's happening, because I think that's when we're going to see the bigger effects of tariffs on inflation and consumers really pull back.
Dana, I've been trying to pin down how workers' wages have kept up with inflation. As I've been saying, Torsten Slok put out a 6-year average showing that wages are doing better than inflation. But Mark Chandler, whom we just spoke with from Bandenbrook, says in his household that certainly isn't the case, and he doesn't think that it looks like a great picture for consumers. How do you see it?
Well, yes, wage growth and compensation have been slowing from the peaks that we saw during the pandemic, certainly the later portion of the pandemic, when we were trying to get everybody back into the labor market, and you need to entice them and also keep workers with compensation. But still, I would say that wages are still growing at a pace that's above where we were between the great financial crisis and the pandemic. But I would look at the last GDP data where we saw real disposable income grow at 0.0 percentage points annualized in the third quarter. That's not a good sign. And so we definitely do see slowing in wages. And for some people, it may be faster than others.
Dana Peterson of the Conference Board, thank you so much for being with us this morning on the first trading day of the new year. Coming up next week, we get ISM manufacturing as well as services, which is going to be really interesting. We get JOLTS data, some of the jobs data that we did not get last month. We also get ISM services, jobless claims. And then, of course, the big one on December, we get the December payrolls print. How much is this really, Matt, going to set up the tenor for 2026 after a lot of confusion around the data that we've gotten?
I hope that the data that we get now is less and less messy as we get into 2026, because what we've seen over the past couple of months due to the government shutdown has been really difficult to interpret. I doubt that that's what we get with the December non-farm payrolls, because you've got to think about the holiday, right? And it's just not the kind of clean look at labor that economists really want to see.
Yeah, and there's a sense that we don't really understand the numbers once they do come out. What is the break-even rate for the U.S. labor market in terms of job creation, given the fact that there is a shrinking or at least stagnant population of new workers coming in? The expectation right now that people are expecting is 55,000 jobs created in the month of December. That would be down from 64,000 in the prior month, although people are expecting a revision downward in terms of the December jobs growth, actually expecting a contraction in the month of December. We will get that data coming up next Friday on January 9th. Coming up, Catherine Rooney of Vera of StoneX Group, Bloomberg's Ed Ludlow ahead of CES, RJ Gallo of Federated Investment Management, and Bloomberg's Craig Trudell from New York. This is Bloomberg Surveillance. Happy New Year.
That big story is really going to continue to be AI and tech.
I think you stay in a Mag 7.
It's still so early in this game that it's very hard to declare where the ultimate winners are going to be.
The same sectors that have been strong for a couple years before are going to continue to be strong.
It doesn't take much disruption to have quite a few domino effects that are going to impact the market in a more holistic way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, kicking off 2026 with a bang as futures build on 3 straight years of double-digit gains. Wall Street feeling good about the year ahead with widespread optimism about a lengthening in the bull market and some real gut checks on deck from the Supreme Court decisions, next week's jobs report, as a key indicator ahead of the Fed's rate decision later this month. Matt Miller alongside me, and there really is this feeling that right now we're a little bit in the dark at the end of 2025 and that we should get some light in the next couple of trading days.
Yeah, hoping to get some more data that's less noisy, hoping to get a better picture of the labor market, especially. That's what people, I think, are most focused on rather than inflation, which is interesting.
Yeah, right now we are seeing the optimism in the AI trade continue. Right now, NASDAQ futures up almost 1% ahead of the open. You are seeing a bit less of a decline, less of a gain in S&P futures, up 0.6%. Russell 2000 doing a bit better at 0.7%. A bit into bonds, even though earlier you did see some volatility, pretty much across the board down about a basis point. Still watching, though, the steepening in the yield curve, a real question as the Fed is expected to cut rates at least twice this year. And then on the inflation side of things, metals across the board had a banner year in 2025. They are continuing that today. Gold, silver, aluminum, copper, all of them up. Silver up 3.25% after a 148% gain in 2025. Coming up this hour, Catherine Rooney-Vera of StoneX Group as stocks edge higher on the first trading day of the new year. RJ Gallo of Federated with U.S. Treasuries extending gains after their best year since 2020. And Bloomberg's Craig Trudell previewing Tesla's latest sales numbers. We begin this hour with stocks rising to kick off 2026 in what is expected to be yet another banner year for markets. Bloomberg News surveyed 21 strategists. None of them are expecting the S&P 500 to decline this year. The most bullish forecast coming from Oppenheimer, calling for the index to hit 8,000. Bloomberg's Alexandra Semenova reporting an optimistic consensus has taken hold. The U.S. stock market will rally in 2026 for a fourth straight year, marking the longest winning streak in nearly 2 decades. That would bring us back to the late 1990s. Alexandra, I'm so pleased to say, joins us now. Alexandra, wonderful story, wonderful reporting.
Thank you so much.
Is this something that's worrying? And I don't mean to be negative, Nellie, but the idea that everyone in the world's optimistic and that no one is expecting declines.
It seems to be, because when you think about this year, there should be a wide range of potential outcomes for markets when you consider where valuations are and all of the risks. We are uncertain about whether companies can monetize their heavy AI investments. We have a Fed in transition, geopolitical fractures. And yet, when you look at Wall Street's outlook for U.S. equities, it's almost as though nothing can go wrong. Of the 21 sell-side strategists that we track from the big shops like JP Morgan and Goldman Sachs, no one is predicting declines in the S&P 500 index. In fact, on average, they're predicting another 10% gain. And not only are they unanimously bullish, those forecasts are also clustered. The lowest at 7,000 from Stifel and the highest from Oppenheimer at 8,100 represents a 16% gap, which is the lowest since 2017 rather. So when you're thinking about next year, perhaps the biggest risk is complacency, because when you move in this lockstep optimism, it won't take some exogenous shock or a recession to disappoint markets, but something as small as an earnings miss.
Well, there's also been a confusion around whether the economy can continue to lag behind some of the enthusiasm that we've seen when it comes to equity markets. Is that something that's expected to continue as well, with maybe a sluggish U.S. growth backdrop at the same time as another 10% year of gains?
Yeah, it seems like Wall Street strategists are acknowledging those risks. However, they actually see a reacceleration in the economy. They're pointing to the Fed's easing. They're pointing to tax cuts giving the economy a boost. Some have pointed to the World Cup being hosted in the U.S., and that is supposed to actually lift some of the lagging segments of the economy and help broaden out this rally. When you look at earnings growth also for the S&P 493, they're finally supposed to catch up next year. And the first quarter, that group is supposed to post earnings growth of 11%, the Mag 7 about 15%. So that gap also narrowing.
A wonderful piece, really comprehensive. Alexandra Semenova of Bloomberg, really great work. Thank you so much, as always. And Matt, this to me is really one of the key questions. Do you get that broadening out that everyone has been expecting?
Absolutely. I was listening very closely when she gave those percentages, because that's what I think about. That's what I ask our guests about most often. So we're not quite there yet where the 493 are overtaking the Mag 7, but we're getting closer and we're getting into double-digit territory, which I think is key for a lot of people that have been betting on this broadening out thus far.
Especially people who are betting that this is 1996 and not 1999. 1999 or 2000. Catherine Runaviri of StoneX Group writing, 2026 will be defined by continued early easing, slowing but positive growth, and a window for tactical real yield relief, which is constructive for duration and equities in the first half of the year. Catherine joins us now for more. Catherine, great to see you. Happy New Year. Catherine, how much are you looking forward to that broadening out that we were just talking about?
I think the first half we're probably going to continue to see upside in the S&P and a continuation of AI specifically leading the pack. I think in the second half, that's where I think we're going to get a divergence in probabilities. And, consensus is packed around the 7,500. I'm there too. But the truth is that in the second half, things can change meaningfully. And what I'm looking at for, between the next 6 to 8 months is an improvement in real yields. And that, I think, Lisa, is what can take the S&P higher. I think, rates are more important at this point than any earnings miss. If we get an upside inflation surprise in the second half, we could see a meaningful decline in the S&P.
So it's interesting. We've been watching the Fed cut rates by 175 basis points in September of 2024. And at the same time, the 10-year yield has gone up to, we almost hit 420 again this morning. How much further do you think that goes? Or does Fed cutting begin to bring down 10-year Treasury yields with it?
Yeah, I don't think it's one data point or one yield tick that changes equity behavior, but I think it's the spread and the source of the rate move. So if it's, long rates rise quickly because real yields are moving due to repricing of term premium or inflation risks resurge, then equities react immediately to the downside. I think that's different from rates rising because growth is improving. So if you get a fast move driven by inflation or supply stress, I think then you'll get a compression of multiples. That's why I'm focusing so much on rate dynamics rather than anything else like headline growth numbers or earnings. I think the transmission from rates to equities is much faster than earnings. So I think the Fed does cut an additional 50 basis points, probably in the first half, maybe even 75. If that bleeds into a reacceleration in inflation, then we get a Fed on hold or even, God forbid, hiking by the end of this year. So what I'm looking at in terms, Matt, of the data that really matters is labor market, how much that pumps up service sector inflation in the second half. But like I said, Lisa started, this is not the 1990s, so we shouldn't expect AI to bring inflation down. Inflation is here to stay. It's sticky. I think that that supply is very productive and in AI, but the fact is that earnings are not quite there and productivity is not in full force. So AI will not diminish inflation completely.
But bottom line is, in terms of what happens in 2026, you think the real risks lie in the second half. So we're, still 6 months away from that. But we do start to get more and more data coming out, as Lisa's been saying, this week, next week. How key is, for example, the December jobs report for you?
Yeah, I think it's all important. I mean, if you see a more meaningful deceleration, then we're going to see additional Fed cuts. If, as I'm saying, in the second half, we get more labor market tightening and we get a resurgence of inflation because of that, then I think that breaks my call. So I am bullish, but if we get a 10-year Treasury that approaches 5% and credit spreads start to widen materially in that back half because of a resurgence of inflation, Matt, I think the equity runway ends. And that's the point. The rates compete directly with equities. So, if borrowing costs rise sharply, financial conditions tighten fast, I think that's where the exact yield level matters. It's a regime change that signals, and I think the equities can move very quickly as a result.
And Catherine, you were saying that is the regime change when the 10-year yield approaches that 5% level, not necessarily the tick, but that regime change kind of competitive edge. How much does the political landscape factor into this, the fact that the midterm elections are coming up and some of the potential incentives that may emerge heading into that?
Well, I think, Lisa, one of the most underappreciated risks this year is term premium and Treasury supply. So if we get this additional blowout of fiscal profligacy, which is, I think, one of the main drivers of why we haven't entered a recession and probably will continue to be the case, then I think the long end does not need stronger growth to sell off. And that's because of this fiscal profligacy. So we've seen it on both sides of the aisle. If, as history dictates, the midterms do go against the incumbent party, then I probably think we continue to see fiscal dominance reign, and we could see pressure on the back end, persistent deficits, heavier issuance, uncertainty around policy credibility could all risk the market, Lisa. I think all of that would push term premium higher. And that's additional risk at the back end of this year, in my view, because it matters. I mean, a rise in term premium can overwhelm policy easing and reset valuations very quickly.
What are you looking for in terms of market activity to signify that maybe people are looking elsewhere for diversification away from the Treasury market?
Well, I can tell you as a global economist, going around the world, that everyone's looking at international exposure. So moving away from the U.S., which looks saturated and highly valued, and into emerging markets. So outside of China, there's a lot of interest in Asia and in Latin America specifically. And I concur with that, Lisa, because I think the U.S. dollar continues to move lower, favoring emerging markets. There's juice there. These are countries that have curbed inflation largely, and a result are bringing down interest rates meaningfully. You can get a lot of juice there. And I think fixed income, especially investors, are looking internationally, and more so in a risk-on environment in the high beta emerging market space.
Catherine Rooney-Vera of StoneX Group, thank you so much for being with us, and Happy New Year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. We begin with tragedy in Switzerland. Officials saying that around 40 people have died in a fire at a ski resort bar where partygoers were celebrating the new year. They estimate that more than 100 others have been injured after flames ripped through the bar at a popular alpine resort, Crans, Montana. Eyewitnesses said that a sparkler in a bottle ignited the ceiling. Elsewhere, President Trump pledged in a late-night social media post that the US will come to the rescue of Iranian protesters if they're attacked by Islamic Republic authorities. The post comes after protests erupted this week in Tehran after the currency slumped to a record low. Demonstrations have since spread to other parts of the country, setting off clashes between civilians and security forces. And President Trump says he's in perfect health. In a post on Truth Social, the president said that he had a perfect cognitive exam, and the test should be a mandatory one for anyone running for president or vice president. Trump's post comes after he said in a recent interview that he had undergone a CT scan in his October exam, not an MRI. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, the morning calls, plus Bloomberg's Ed Ludlow previewing next week's CES conference in Las Vegas. From New York, this is Bloomberg Surveillance.
It's a prove it year, but that actually makes me more bullish because I think now we go into the next phase of AI. I think tech stocks are up 20-25% in 2026. The two best physical AI plays in the world today. It's NVIDIA and it's Tesla. This is autonomous chapter now coming to Tesla.
That was Dan Ives of Wedbush earlier this morning with a bullish call on tech for 2026. You might say, well, he's always bullish. Well, he's been right over the past number of years with tech outperforming. This morning, continuing to outperform with some of the same winners from 2025 reprising their helm at the leading pack. NASDAQ futures up about 1%, above S&P futures up about 0.5%. And Matt, single names, also some of the best gainers in 2025, reclaiming their lead early in 2026.
Yeah, it's really interesting to see, especially these these DRAM companies doing so well. SanDisk, Western Digital, Seagate, and Micron is one of those. Like, I was looking at the best performing ETFs of last year, and gold, obviously, and silver are both up there. But 2 or 3 times leveraged Micron ETF and 2 or 3 times leveraged Palantir ETFs also among the top 10.
Yeah, well, this definitely is something that people are looking at once again. How do you get a broadening out unless you get these particular names continuing to post gains and show profitability? In the bond space, you are seeing a bit of a bid after some earlier volatility, about a basis point lower in the 10-year. The 30-year actually losing some of that advance. You're seeing 4.84%, essentially flat on the day. And in the metal space, as Matt was just talking about, gold and silver last year, best year since 1979. Silver up another 3.4%, gold up another 2%, aluminum hitting that $3,000 a ton mark for the first time in more than 3 years, up almost 1%. Time now for the morning calls. First up, Mizuho raising its price target on Chipotle to $36 and maintaining a neutral rating, believing the stock's current valuation appropriately reflects its new long-term EBITDA growth algorithm. Those shares up almost 0.5%. Next up, Barclays upgrading Vertiv to overweight with a $200 price target, viewing the recent sell-off as an attractive entry point and seeing substantial upside to Vertiv's consensus earnings estimates for the next 2 years. Those shares up 4.4% in pre-market trading. And finally, Athleta Capital doubling, upgrading ASML to buy and boosting its price target to a street high, citing stronger demand driven by suppliers alongside orders from China this year. Those shares up almost 6%. Sticking with tech, big names in the industry, including NVIDIA, AMD, and Samsung, ready to advocate for artificial intelligence at the CES conference next week. Bloomberg's Ed Ludlow joins us now before he heads to Las Vegas to cover the CES. What are you expecting at this year's conference?
Yeah, I mean, for markets, it's called the Consumer Electronics Show, right? But the C part isn't really that interesting, particularly for the buy side. It's AI everything. And it's kind of an issue of timing, that first week of the year where lots of investors fly to Las Vegas to meet with the companies, to meet with each other. NVIDIA is kind of the mainstay of it. It's interesting, NVIDIA is not officially a keynote speaker of CES this year, but they're holding their own Las Vegas event. And there's really expectations going into that you will hear substantive commentary about AI infrastructure, supply chain, and that because of that, you get real earnings visibility. You know, a year ago, it was kind of just before President Trump returned to the White House, and it was very political what was being discussed, trying to preempt tariffs. But the one thing I'd add is Matt is absolutely right to bring up DRAM, because across electronics right now, the pricing and supply chain pressure is starting to come back a little bit.
HB DRAM. I know all about it because I watch your show. Ed Ludlow also co-anchors Bloomberg Tech, of course. Ed, you also cover cars pretty deeply, and the intersection between cars and tech has been highlighted by the CES events of the last, 5 to 10 years. Dan Ives earlier telling us that the two biggest AI plays are NVIDIA and Tesla. I haven't seen any official announcements, but what are we going to hear from Tesla at CES?
Well, remember that Boring Co. has tunnels that connect all of the different convention centers in Las Vegas, and it's Tesla vehicles that drive you through those tunnels. Every year, Ian King, who covers semiconductors for Bloomberg, would walk the 10 feet from his desk to my desk this week and say, do we need to write a CES preview about how it's going to be all about cars? And for many years we did, until this year, where actually I think that idea around automotive technology, not just autonomous driving, but the in-car experience has kind of fizzled out a bit. Tesla is very selective of where it kind of exhibits its products, and CES historically has not been one, although there will, there's a big ambition for them in 2026 to expand the robotaxi fleet offering, and you'd expect that Las Vegas and Nevada is a target because Zoox are already operating there in the autonomous driving space, and Waymo recently got approval too.
What about deals, Ed? I mean, anytime you have a gathering of the most powerful executives in industry, you could expect them to talk to each other, have their bankers talk to each other, have their lawyers talk to each other. Do we see a wave of deals after this?
Historically, there are conversations that take place, and you're exactly right. It's basically like speed dating. In fact, it's not just the bankers and investors. There are lots of CEOs in the world of technology that will go to CES unofficially and keep a low profile because it's interesting for them to see the field, but also it's a great opportunity to have dinners, lunches, and do it quickly. I'm trying to rack my brain for something that may have come out of CES this year, but particularly supply chain related things right now, there's a lot of focus on that, whether it's like telematics and sensors that go into cars, Or, on the consumer side, one of the big deals that came out in 2025 is Dell, a maker of PCs, started using AMD processors for the first time. That was a major deal that was announced at CES. But that's the interplay, right? It's called the Consumer Electronics Show. But in reality, the attendance and the kind of news flow is driven by a much higher level of corporate activity. So that's kind of those kinds of relationships that you look out for.
Ed, if you take a step back, it seems like this is the prove-it year for artificial intelligence, a reason for the broadening out trade that people are hoping for, that the other 493 companies will spend more money on some of this technology in order to get an edge or remain relevant. What are you looking for at this year's CES to indicate that that kind of broadening out, that profitability backdrop is truly coming to the fore?
Yeah, I don't want to contradict myself necessarily. That's where the C, or the consumer part, is important. So, for example, if we take DRAM or memory chips, prices are going really high because memory chips are in short supply. They're going into the high bandwidth memory stack. It's layered up DRAM that goes into data centers. A consequence of that is that PC prices are getting higher and higher because the cost of manufacturing is higher because of the DRAM. There isn't actually that much evidence that consumers are that interested in AI PCs. And if you look at the forecast for the global PC market in 26, it ranges from IDC saying it will shrink 9% to others like Omdia saying it will basically be flat or grow because of AI PC. There's probably not been that much love reflected for those names in the market where there is a direct consumer play on AI. And like smartphones and PCs are part of them. Qualcomm will be there at CES, and they kind of felt a little bit aggrieved that their competence in processors specifically for AI smartphones hasn't sort of been realized by the market. So that's how I'd say it. I'd say, like, is there any actually tangible evidence, Lisa, that all this AI stuff, it actually means anything to anyone that's attending there, and then that shows up in the sales data for the coming 12 months?
Well, Matt Miller here spends 3.5 hours on ChatGPT a day to get tips on his motorcycle and car repairs. What about you, Ed? How much do you spend, not necessarily on ChatGPT, but just in general, with different AI tools?
A lot, hours of the day, and like it's really interesting because I wish there was a better way to track it. ChatGPT I use in research and like going through dense documents and sell-side notes. Like if you have a ton of sell-side notes, it's really useful to run them through ChatGPT and look at comparisons, compare and contrast, etc. On the way into work, right, I use Tesla Full Self-Driving. So my car drives the 30 miles or so from my house to the office. And I use Grok, which is XAI's chatbot in the car because it's hands-free. I can just chat with it. But again, like that's different because ChatGPT at Bloomberg LP, the parent company of Bloomberg Television, Bloomberg Media, we have a corporate subscription for that. I'm not paying $20 myself personally for each of these different services. Some of them I do, but some of them we have access to through our employer. Yeah. That's also, to answer your last question, going to be another part of the story. Like, where is it that the consumer is willing to spend on software?
Ed Ludlow, thank you so much for being with us. And Matt Miller, you pay for it, don't you?
I have my corporate subscription. I also pay for a private subscription because I don't need to mix those two things. And I pay for Gemini as well. So
there you go, an equal opportunity user. Yeah. Have you ever done Tell Me About Myself, and it gives you like a profile based on everything that you've looked at? It's really quite interesting.
I never will.
Yeah, well, it's like a ChatGPT horoscope. Coming up, RJ Gallo of Federated Investment Management with U.S. Treasuries extending their gains after their best year since 2020. Plus, Lizzie Burden with your morning movers, Wayfair and RH up as President Trump delays some furniture tariffs. This is Bloomberg Surveillance. Seeing a lift to start 2026. Good morning. Led by big tech, finishing off, we're picking up where we finished off in 2025. NASDAQ futures up about 1%. S&P futures up by about 0.5%. You are seeing a bit of a bid into bonds after last year's rally. We'll get into that in just 1 second. Still, 10-year yields at 4.16%. The euro losing clout versus the dollar. A bit of dollar strength after the worst performance for the greenback going back to 2017. Still 117.21 on euro dollar cross. And crude declining once more, down 0.8%, $56.94, despite some geopolitical tensions. 1 hour away from the cash open, here are your morning movers with Lizzie Burden. Lizzie.
Hi, Lisa. Well, I want to start with the furniture names because, of course, President Trump has delayed his higher tariffs on upholstered furniture and kitchen cabinets and vanities until next year, New Year's Day 2027. They were meant to kick in yesterday, but he announced this on Wednesday. And so you're seeing the relief for the likes of RH up more than 5%, even though those 25% tariffs that are already there will remain in place. Turning over next to Baidu because it's picked Hong Kong and filed for Hong Kong to have its listing for its AI chip unit. Now, this is backing the theme of China tech that it's expected to see in this year, and lots of names expected to be listing in Hong Kong this year as well. So getting the ball rolling there. It's already up in Hong Kong, its highest level since 2023 September, and it's up in the US pre-market as well by nearly 10%. Just finally turning back to Tesla, I've mentioned it all morning, but all eyes really on this Q4 production and deliveries report that is expected later on today. We have had the average analyst estimate saying they're going to have an 11% drop when it comes to global vehicle deliveries, but compare that to what Tesla itself said earlier in the week. It took the unprecedented step of releasing the average estimate according to its own average, and that was a 15% drop. So more pessimistic, and that disparity perhaps explaining why it's up in the pre-market, Lisa.
Thank you so much, Lizzie. We are getting delivery numbers across the board. We're getting Rivian fourth quarter delivery and production numbers coming in around 10,974 in terms of production. Deliveries just under 10,000. Those shares also up by about 1.3%. Turning to the bond space, RJ Gallo of Federated Investment Management writing, U.S. Treasury yields seem likely to remain constrained in a narrow range to start the new year. As the U.S. economy continues to expand, RJ joins us now. RJ, I'm really glad you're here. Thank you so much for being here, because this is, to me, one of the most confusing parts of the market. A lot of people think that there is going to be very muted action in Treasury yields at the same time that a lot of people are saying inflation is still very much a risk. Why do you see those two things as compatible?
Well, good morning and Happy New Year. Those two issues on the surface are not directly compatible, obviously. The fact is that the inflation pressures that we had experienced have substantially diminished. They have not diminished enough to restore the Fed's 2% target. And I do think that were it not for the inflation concerns, the 10-year would be below 4 right now. And it's obviously not. So, we're coming off the tail end of a very bullish year for fixed income, but the threats looking forward continue to be the sort of dichotomy between a weakening labor market where job creation has slowed to a crawl, might even be negative, and inflation continues to be an issue because you have fiscal stimulus, you have the effect of Fed easing, and you have the AI capital spending all going on at the same time that high-income households keep spending. So the Fed's in a tough spot. I think the inflation risk has not been diminished substantially enough for a real bond market rally. And I think on net, we might be hemmed in on both sides from that dichotomy.
RJ, if we do get a Fed that is incentivized for a variety of reasons, most of which is the labor market that you were just talking about, to cut rates significantly this year, or even just by 75 basis points, do you think that the 10-year and the 30-year will rally? Or will we see an ongoing steepening of the yield curve akin to what we saw last year?
Our highest conviction bet in 2025 was a steeper yield curve. That worked extraordinarily well, generated some excess return in our portfolios. It remains our highest conviction bet as we enter 2026. It's interesting, Matt, I think, mentioned earlier that since the Fed actually started its easing I think it was September of last year, the 10-year Treasury yield has actually edged higher over that time period. Now, on net, the 30-year ended the year up 6 basis points, even though the 2-year fell almost 70. So I think the engine of steepening persists. If the Fed eases a couple more times as they struggle with this slow job creation yet lingering inflation challenge that we just touched upon, it's quite likely that the curve will continue to steepen with the short end going down, and you might even have some cheapening at the long end. The term premium is heavily linked to the fact that Fed independence is in question, and fiscal stimulus is coming through the pipeline as we get into next year. We think the steepening will probably still persist.
What does that mean for the U.S. economy, RJ? I mean, a steeper yield curve sounds like good for banks, but how is it for, the industrial economy?
Well, borrowing costs in the corporate space, spreads are very, very tight, and corporations have done well. Earnings have been relatively buoyant. AI is all that anyone wants to talk about, but generally speaking, large companies continue to do relatively well. And what was a pretty volatile 2025, corporate bond returns were strong, spreads are very tight, in our opinion, a little too tight, so we're a little underweight in the corporate space. Nevertheless, a steeper curve, I think, will create a challenge for the Trump administration's priority of trying to get mortgage rates to fall substantially. Housing has been struggling. It's detracted from GDP now for most of the last 8 quarters. And that's because mortgage rates are so high. Mortgage rates are not set off the 2-year. They're out the curve, set off the 10-year. So that steepening curve will probably continue to be a bit of a challenge for housing. I do think corporate financing is holding up just fine, even though the absolute yields are relatively high. And the spreads are tight. Corporations are certainly hungry for more and more capital, as we've seen.
There was a little bit of a concern about cockroaches last year. It seems to have abated. Still interesting to see that the non-bank lenders are doing so much worse than the big Wall Street banks. Lisa was pointing that out earlier this week. How do you expect that to play out? I mean, are the bankruptcies that we saw, you think, idiosyncratic?
Well, the business development companies are probably on like a nice lens. The equities of business the business BDCs are a nice lens on what's going on in private credit. And obviously, they've done rather poorly. Jamie Dimon's comment about cockroaches, I think there's probably some truth to that. I don't know if cockroaches are going to ruin the house. It might be a problem in the kitchen and might need to bring in some exterminators. But generally speaking, our view on securitized credit, from what we can tell, and on private credit is one of a bit of concern, but I don't think we're about to run out of the house because of a few cockroaches in the kitchen. So I think it continues to be a risk. We are watching that risk. I think generally speaking, spreads are tight throughout the private capital markets, and as a result, we've been a little cautious on the corporate side. Now, on the asset-backed side, I think we're more constructive and think that some of the problems that we saw were somewhat idiosyncratic. Even if you find a few more, it doesn't necessarily mean, like I said, that you need to run out of the house.
RJ, a lot of people have been saying this, that credit spreads feel too tight for a couple of months now. And I'm looking right now at high-yield bond spreads, and they're at some of the lowest levels that we've seen post-financial crisis. At what point is this just a factor of money looking for places to get yield, right? And at what point do the technicals overwhelm the fundamentals that might say it feels just a bit rich?
Well, that's a great point. I think that the absolute yield buyers, after like a decade of suffering from low absolute yields, have been very attracted to the simple fact that absolute yields are much higher, even if spreads, in fact, are very, very tight. You mentioned technicals. The technicals have been on the side of tightening. You sort of wonder, are we going to flip that script in 2026? You have large structural deficits in the United States, other developed countries as well. You've got a huge capital expenditure need with more issuance to come from the private sector. The cumulative effect here might actually start to go in the other direction. For quite a while after Liberation Day, if you want to rewind to April, it felt like a recession was the odds-on bet, and that would widen spreads. That didn't happen. A lot of people overreacted on that front. It was very common in the markets. But now it's quite possible that we would just see a spread widening on the simple deterioration in the supply-demand mix, in addition to the fact it might just take a couple of bad earnings prints on the payoff and the returns on AI that could cause a real reevaluation on credit risk, and spreads could widen in tech in that space. And that would be enough to cause some meaningful widening on the corporate space. Then we would have to reassess if we get that event.
Given the international focus this year and the fact that spread widening as well, with respect to sovereign bond yields, the idea that longer term yields have risen so much, it really has been a global story. How much do you think that the U.S. is going to really underperform the rest of the world? Or do you think that the U.S. could even outperform, even with yield curve steepening, because of the Fed remaining in play?
Well, the central bank divergences have been pretty stark of late. We were talking earlier about the weakness in the dollar. That was in part contributing to the weakness in our currency. There was obviously other big factors going on there as well. Our views for fixed income total returns in the U.S., mid-single digits is probably the best you're going to get. We just got off a period here where we had the treasury index, the Bloomberg Treasury index, was up 6.3%, best in many years. The aggregate index, you throw in some corporates and mortgages, 7.3%. These are very nice and attractive bond returns, numbers that often get eclipsed by the double digits in equities. But there are plenty of Americans who own fixed income to complement their equities. And guess what? They've both done extraordinarily well. I think the outlook for returns in the coming year in the U.S., a little bit diminished relative to those levels, yet still more likely than not significantly positive. Relative to the rest of the world, it's a tough call. I mean, I think that the inflation threat here is a lingering challenge. The Fed is apt to ease, especially with its change in leadership coming as President Trump gets to put more of an imprint on the central bank. That should be good for fixed income, but maybe not all fixed income, as that steepening curve will mute the overall total return. The 2-year fell almost 70 basis points last year. The 30-year went up 6. We could see more of that dynamic, and that would mute the return profile somewhat.
We had a guest on earlier, Catherine Rooney-Vera, talk about profligate spending, which I love. And we have, as you mentioned, kind of a threat to the independence of the Federal Reserve. Is that apt? Are those two things apt to drive yields much higher from here? Because I haven't seen the bond vigilantes really flash their whites of their teeth yet.
Yeah, I mean, we talk about the bond vigilantes, and it seems like, where are they? I think there's a couple things to note. The Treasury index ended the year at 389. It started the year at 445. Meanwhile, the term premium, which is a model-determined concept, but the term premium steepened out pretty substantially last year. If you look at the New York Fed's term premium, it's risen up over 70 basis points. It wasn't that long ago that it was at 0. So I think that I don't know if it's vigilantism as much as it is conservatism. That bond investors, often a little more cynical or skeptical than our equity colleagues, and the threats that you just described, continued fiscal profligacy, the simple fact that the central bank is getting, a complete changeover in control after what have been, complete aggressive attacks from the administration on the central bank to a degree that you don't typically see. You'd have to go back to LBJ shoving the Fed chair up against the wall at his Texas ranch to come up with anything quite as close, even though I don't think President Trump assaulted Jay Powell, but he certainly has verbally. So when you look at the threats to the central bank on the fiscal side, that you should see higher term premium. That's steeper curves. That's more muted returns at the long end. That is fiscal, that is bond market conservatism. Maybe not vigilantism, but conservatism.
RJ Gallo of Federated Investment Management, thank you so much for being with us this morning. Have a wonderful rest of your weekend. Happy New Year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. The U.S. continuing to ramp up the pressure on Venezuela. The Trump administration sanctioned Chinese companies and oil tankers linked to Venezuela. This coming as the U.S. launches more strikes on purported drug trafficking boats. Venezuelan President Nicolas Maduro says that he's open to negotiating with the U.S. to combat drug trafficking, but said that the U.S. is trying to force him from power and gain access to Venezuela's oil reserves. Elsewhere, we have Rivian shares rising in the pre-market after its delivery numbers slightly beat estimates in the fourth quarter. The EV maker produced nearly 11,000 cars in Illinois and delivered over 9,700 during the same period. Rivian also announcing that it'll release its fourth quarter and full year financial results on February 12th. And in sports, the college football quarterfinals took centre stage over the holiday. In a New Year's Eve stunner, Miami shocked the defending champs Ohio State 24-14. Meanwhile, top-seeded Indiana remained perfect, crushing Alabama 38-3 in the Rose Bowl. Elsewhere, Oregon shut out Texas Tech 23-0. And I'm going to get it right this time. Ole Miss outlasted Georgia in a 39-34 thriller. Olé! That's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. Olé, indeed. Up next, setting you up for the day ahead, including a preview of Tesla's sales numbers after, as Lizzie was mentioning, we did just get Rivian from New York. This is Bloomberg Surveillance.
we are just at such this early stage of people really thinking about PROSEC or production for security or resiliency that there's a lot more going on. We're going to see this. We're going to see this through the electricity industry, whether it's nuclear. I just think, and again, this is an administration that is well aware that if stocks are not doing well coming into the midterms, it does not bode well. So look for lots of pushes to get the stock market going.
That was Peter Scheer of Academy Securities in a brilliant look at what he's looking for this year, particularly with his PROSEC outlook on the world. Right now, you are seeing optimism to start 2026, led by, guess what, big tech, leading the charge here, up about 1%. S&P futures up 0.5%. You are seeing just a bit of dollar strength, and despite what some people are saying, could be another year of dollar weakness. Euro 117.21 versus the dollar. A bit of a bid into bonds, but fading as the market grows older. 10-year yields 4.16% in silver. Another fantastic day after a fantastic year of 148% gains, 3.2% gains this morning in early trading. Counting down to the opening bell, here's the trading diary for the week ahead. On Tuesday, CES kicking off in Las Vegas. Watch some of the innovations. Wednesday, ADP data, JOLTS and ISM services. Finally, the data comes Thursday. Another round of jobless claims and the trade balance on Friday. The big one, the December payrolls report, the first clean read since the government shutdown. Also, University of Michigan sentiment survey. Before we get to all of that, Tesla set to follow Rivian to report its global fourth quarter sales shortly. Analysts expecting deliveries to fall 11% from a year earlier, while Tesla is even more pessimistic, calling for a 15% drop. Joining us now is Bloomberg's Craig Trudell. Craig, thank you so much for being with us. First, can you just give us a sense of what happened here, why Tesla tried to get out ahead of analysts that were surveyed by Bloomberg by giving a pessimistic outlook before this number?
Yeah, this was quite a curveball. We're used to getting those from Elon Musk, to be fair, but for the first time, the company posted on its IR website a consensus. So they put out averages both for the fourth quarter, for the full year, and actually going out a few years. And consistently, whether you were looking at fourth quarter or for full year 2025, even out the next couple of years, you actually saw the company compiled consensus that Tesla put out was more pessimistic than what the analyst averages that we compile on the Bloomberg terminal. So this was a bit of a surprise, and I think was sort of widely perceived as the company kind of lowering the bar for itself going into today's print.
So if we see a drop of, 15% as the most pessimistic average would suggest, or even 10%, it makes me wonder about EV sales growth in general, beyond Tesla, both in the U.S. and globally. Aren't we still seeing gains?
I think, when you look at BYD, which actually just reported yesterday, we are both seeing, their sales continue to grow, and yet some softness in their numbers relative to the last couple of years. So I think globally, you're seeing the momentum in battery electric vehicle sales growth, really sort of losing steam. In the U.S., I think it's going to be a different story. Rather than just losing momentum, some possibility that you actually see sales declines. And I think, certainly in the near term, that feels likely, just because in the third quarter, we saw such strong demand to try and take advantage of the federal tax credits that went away after the end of September. And we are widely expected to see huge payback for that in the fourth quarter. And that probably will carry on into the early part of this year. I think in terms of in Europe, it's maybe a different story where, we've seen Tesla be really weak in this region, and the Chinese players led by BYD are really sort of taking off, even despite, some trade protectionism, some tariffs that went into play in late 2024.
What does this mean, Craig, for EV sales, beyond Tesla and this quarter? For the world over the next 3, 4, 5 years, because we've started seeing a rollback in regulations as well. I thought, Europe wasn't going to allow any more new gas vehicles to be sold after 2035, but that apparently is changing as well.
Yeah, and that was another big development in December that was very interesting to see. I think it was somewhat incremental, and at least on headline figures, where instead of aiming for 100% reduction in new vehicle CO2 emissions by 2035. That number is going to go down to 90%. But there's, sort of, little ways in which you can sort of fudge that number to some degree as well. So I think, in short, we're going to see a longer leash for hybrid vehicles, particularly plug-in hybrids in Europe. In the U.S., I expect to see more conventional hybrids that don't even have plugs. You think of this sort of base Toyota Prius. Those have been selling really strongly. You have a sort of situation where more and more manufacturers are sort of throwing in the towel on battery electric vehicles because they have struggled to make them pencil. And Ford, I think, was probably the biggest example of that late last year to announce that they were going to take $19.5 billion in charges related to unwinding various electric vehicle projects, doing away with the F-150 Lightning. That was a huge development, and we should probably expect more of those sorts of announcements to come from some of their competitors that similarly are going to struggle to sell EVs in this new environment without those federal tax credits.
Craig, just quickly, taking a step back and looking at 2025, how much of some of the sales declines for the likes of Tesla were because Elon Musk is such a lightning rod versus just the incentives went away? And you're seeing Rivian also with declining sales and deliveries versus last year, versus 2024.
I think no doubt Musk hurt Tesla last year. I think, there are some questions about whether or not some of the, revolt against Musk has dissipated somewhat. We're going to see in the months to come, I guess, an easy comparison for the company. So if we continue to see declines for Tesla, in the next couple of quarters, it's going to be really troublesome in terms of, the state of this company's sort of here and out business. Thus far, he's managed to keep everybody focused on the future and on robo-taxis. But there, too, I think there's been some letdowns in terms of execution and, some questions about how much that can continue in the months to come.
Craig Trudell of Bloomberg, thank you so much for being with us. And Matt Miller, are you didn't look for an electric motorcycle as you Google ChatGPT some of the new details?
I have ridden some pretty impressive electric motorcycles. 10 years ago, I started riding electric motorcycles. I haven't bought one yet, but we are going to see electric motorcycle racing manufactured by Ducati in MotoGP, which is the top class in the world. So it could become something that you see more and more often.
But you don't hear because they're silent, which is
That's
kind
right.
of a lovely feature here. Matt Miller, thank you so much for being with us
been
this
a pleasure.
week. It has been such a delight to have you. Coming up on Monday, Lori Calvasina of RBC Capital Markets, Ed Yardeni of Yardeni Research, Lisa Shallett of Morgan Stanley, and Aditya Bahave of Bank of America Securities. This was Bloomberg Surveillance as we bring you into the new year. Happy New Year. This is Bloomberg.